We have two interesting topics to deal with. The first topic is leases. So there's a relatively new leasing standard. Okay, so we'll be going through the leasing standard in the morning. And then in the afternoon, we're going to do taxes. And I understand there are some challenges around income tax accounting in North Macedonia. So I think that will be a very useful session. You're not alone in the world. There are challenges in income tax accounting in many jurisdictions of the world. Okay, so but we'll help you with that to the extent that we can. Okay, so today we're going to start in the morning with leases. So IFRS 16 is a relatively new standard. Okay, the idea behind IFRS 16 was to change lessee accounting. So lessor accounting isn't particularly changed by IFRS 16. We just carry on with lessor accounting pretty much as it was before. But lessee accounting is supposed to have changed quite substantially. So the idea is that all leases would be on balance sheet for lessees. Okay, but that's not true. Okay, so the spin is all leases are on balance sheet, but you will see they're just new exceptions. So we're still going to be doing operating lease accounting for many leases, but the boundary between what you used to do operating lease accounting for and what you now do operating lease accounting for has shifted. So I think it's fair to say we have many more leases on balance sheet, but there are lots of exceptions. Some of the exceptions are mandatory and some of the exceptions are optional. Everybody seems to use the optional exceptions too. So that means lots of leases are still not on balance sheet. Okay, so the more things change, the more they stay the same sometimes. Okay, so there's a little bit of that in this leasing standard. Okay, so there is some improvement, but it's not nearly as much improvement as people like me would like to have seen. I would like to see all leases on the balance sheet. And then also, what actually gets onto the balance sheet is interesting. So you've all hired a car when you go on holiday somewhere. Okay, so you have an obligation to pay. Okay, so unless you use the short-term lease exception, your obligation, your right of use would go on balance sheet and your obligation to pay would go on balance sheet. Okay, but there's also an obligation to return the car, isn't there? Okay, so that doesn't go on balance sheet. Okay, so, it's a social science. We just decide what are we going to put in the balance sheet, what aren't we going to put in the balance sheet. Okay, so the way that the leasing standard is written is not capturing all of the economics. Okay, you don't capture the obligation to return the car. Okay, you just capture the obligation to pay for the right of use of the car, and that's what goes on balance sheet. And most of these you would use the short term. It's an optional exception, but most companies would use the optional exception and not put that lease on the balance sheet anyway. So they would still just do operating lease accounting for that. Okay, so when we look at these examples, if you've been using the old leasing standard, you will see, the lines have shifted a bit. The way we think about things has shifted a bit, but a lot is still familiar. So it's not going to feel like too much of a change. So remember, the version of IFRS that we're speaking about throughout the workshop is the version that is effective, not necessarily in North Macedonia, but IFRS is issued by the IASB 1 January 2024. Okay, and I understand that North Macedonia is using an older version of IFRS and stepping up to a newer version of IFRS from this year. Okay, but we're speaking about IFRS is issued by the IASB here. Okay, so we're hoping through this session you'll get a better understanding of the leasing requirements under IFRS 16, the leasing standard, and particularly be aware that it's quite different for the lessee compared to the lessor. The lessor pretty much stays the same, so there's nothing too much new in that space. And of course, like yesterday, we're going to focus on the judgments. We're going to try and help you to teach others how to make these judgments, regulate these judgments, audit these judgments. Okay, so we've got a little mini case study that we will do a little way into the morning. Okay, but first we'll try and understand all the different requirements from the lessee's perspective. Okay, so scope, what is in the scope of the standard can be a little bit tricky. Okay, so is something a lease? Is it not a lease? That can be quite difficult to judge sometimes. So are you just receiving a service, or are you actually, leasing the asset? And calling it a lease doesn't make it a lease. You have to look at the economics to see that in economics it's a lease. And drawing the line sometimes is a little bit difficult. There is a kindness for lessees. So say you rent a photocopy machine at your business, and the photocopy machine comes with, it's a serviced photocopier. If something goes wrong with the photocopier, the lessor will come fix the photocopier for you. Okay, so the lessee is allowed to, if they want to, not split that into a lease and a service contract and just account for it all as a lease. So from the lessee's perspective, that's a little bit easier. The lessor can't do that. The lessor has to account for the fact they have rented an asset out and they're providing a service. So they'll be looking to IFRS 16 for the leasing accounting, and they'll be looking to IFRS 15, which I think you did with Daryl yesterday, for the service contract that they're providing you with services. So, knowing where all these little lines are matters when you come to apply the standard, and understanding where the exceptions are. Typically, if exceptions are provided, people like to use the exceptions where they're optional. Okay, because it's more work to capitalize the asset on the balance sheet and the liability than it is just to expense the lease payments on a straight line basis. So in my experience, almost everybody uses the optional exceptions that we'll have a look at. Okay, so from the lessee's perspective, we're interested in the liability and we're interested in the asset, because we're going to put the asset on the balance sheet and we're going to put the liability on the balance sheet unless one of the many exceptions apply. Okay, and then a lease liability is just a liability that arises from a lease contract. So you have to identify lease contracts. Okay, and then the liabilities from that contract, okay, will be lease liabilities. Okay, the right of use asset, okay, is going to go into the balance sheet as a right of use asset. But the measurement models that you're allowed to use for the right of use asset, okay, aren't so much specified in the leasing standard. They're specified by looking through to the underlying standard. So if the item that you are leasing would be otherwise investment property, okay, then you would be looking through to investment property standard. And if it's property, plant, and equipment, you'd be looking through to the measurement models in property, plant, and equipment standard. Okay, so typically people would use the cost model under both of those standards if they're allowed to, okay, because people choose not to do good accounting. They just choose to do easy accounting if they can. Okay, but then if people with property, plant, and equipment that they have rented in and raised a right of use asset want to use the revaluation model, then they can use the revaluation model. Okay, and if they are using for investment property fair value instead of cost model, then they use fair value model for property that they're renting in and renting out to other people. Okay, so that's the basic thinking that there is in this in this standard. Then also for those liabilities or leases that we choose by using the exceptions not to put in our balance sheet, just like you have to under the existing accounting you have to consider whether you have an onerous contract or not. So if you have an onerous contract, then you must account for the onerousness in that contract. Okay, so all that thinking still sits there from the previous standard. Okay, so we're going to start with something that I think is one of the more difficult things that needs to be done. Okay, this only is difficult in the cases where it is difficult to determine whether or not you have a lease. So for most leases, it's straightforward. You can see whether you have a lease or not quite easily. But in some cases, it can be difficult to determine whether you have a lease. So this is an important determination because you're applying the wrong standard. If you say you've got a lease when you don't have a lease, you're applying the wrong standard and you're going to do the wrong accounting. Okay, so sometimes for some leases, it can be difficult to determine whether or not you have a lease. Okay, so we're starting the morning with a shock. Okay, we're going to do the most difficult thing first, I think. Okay, so the definition of a lease basically has 3 points that need to be met. Okay, so it's a lease contract, obviously, but it must convey the right to control the use of an identified asset. So you have to find the identified asset, and you must control the right to use that identified asset, and it must be in exchange for consideration. Okay, so it has to be an exchange. You're going to pay something to get a right to use something. That thing that you get the right to use must be an identified asset, and that can get a little bit tricky. Okay, and you must control that identified asset, and you must be able to obtain substantially all the benefits from the right to use that underlying asset. So it sounds straightforward, and for most leases, it is straightforward. But for some leases, it's been going to the interpretations committee already, saying, do I have a lease? Don't I have a lease? Okay, so it can get a little bit tricky. Okay. So this idea of it being physically distinct, the thing that it is you have a right of use over, is where some of the questions come from. Okay, and does the lessor have the right to substitute the asset? So is there an identified asset? So is it, this machine that I'm renting, or can the person I'm renting this machine come in and replace this machine with another machine whenever they want, basically? Okay, so those are some of the things that we have to think about whether there is an identified asset or not. Okay, so this example has been considered by the IFRIC. So if we look at examples where people have found it difficult to decide whether they have a lease or not, and go through the thinking the interpretations committee went through to make their determination, that helps us understand where the lines are. Okay, so this is an oil and gas pipeline. So the pipeline operator, okay, enters into an agreement that gives it the right of use to lay the pipeline at a particular, geographic coordinates through somebody's land, and they're going to pay for the right to place and operate the pipeline through that person's land. Okay, so now, is this a lease or is it not a lease, is basically the thought process that we have to go through. So the contract specifies the exact location, the dimensions, the path, the width, the depth, and everything about this pipeline. So the contract is clear exactly where the pipeline is going. Okay, and the contract gives the customer the right to perform inspections, repairs, and maintenance. So you, as what we'll call the lessee, has the right to go and inspect your pipeline, to maintain your pipeline. So you'll have to dig up the surface soil to be able to do that, but you have the right to do that. So it's very clear exactly where your pipeline is going, and it's clear that you have the right to determine what goes through that pipeline, and you have the right to maintain that pipeline. Okay, so you can sell the right to send stuff through that pipeline to anybody. That's all your right. Okay, so the landowner has all the rights still to the surface of the land, other than your right to dig it up when you have to do maintenance to the pipeline. So the question is, okay, so is this a lease or isn't it a lease? So to answer that question, we have to answer 3 sub-questions. And if the answer to all 3 of these sub-questions is yes, then it is a lease. So when you're trying to decide whether something is a lease or not, these are the 3 sub-questions you're going to have to ask yourself every time. So is there an identified asset? Does the customer have a right to obtain substantially all the economic benefits from that identified asset over the right of use period? Okay, and then lastly, does the customer have a right to direct the use of the identified asset? And if the answer to all those questions is yes, okay, then it is a lease. If the answer to any of those questions is no, then it's not a lease. Okay, so these three questions where it's difficult to decide whether or not you have a lease, these are the three questions you're going to come back to all the time. And you must answer yes to all of them. Okay, so when you look at this lease, when we go back here and we look at this lease, what do you think? Okay, so do you think there is an identified asset? When you look at that pipeline, do you think there is an identified asset? Okay, so in this, so we won't open the poll just because we want to go through this quite quickly. So in the room, I'm hearing yes, people are seeing an identified asset because it's specified exactly where it's going and so on. Okay, so, okay. And then the second question, does the customer have the right to obtain substantially all the economic benefits from that pipeline? Okay, so why is this going to the interpretations committee? Okay, so if it's so easy, okay. And then does the customer have the right to direct the use of the identified asset throughout the use period? Yeah, because we can decide what goes through, we can maintain it. So why is this going to the interpretations committee? Okay, this is easy, isn't it? Okay, so everybody here agrees, yes, there's a lease. Okay, but when this standard first came out, people start trying to not see a lease, basically. Okay, so everybody agrees, okay, that there is a lease, there is an identified asset, okay, for the reasons we discussed, okay. So we do have the right to obtain substantially all the economic benefits from it because we determine the exclusive right of it, okay, and yes, we do have the right to use it and maintain it throughout that period. Okay, so that was this was so difficult, it had to go to the interpretations committee. Okay, and you can do it already. I'm very impressed with North Macedonia today. Okay, much more so than yesterday. You can do the most difficult thing we have to do immediately. This is very good. Okay, so does it have a lease? Yes, it clearly is a lease. Yeah. I actually don't know offhand, I don't know. Okay, but whenever a new standard comes out, you're going to have people, you know, asking what sometimes in hindsight look like fairly straightforward questions. Okay, so because it's new, they don't necessarily know what to do. So if I knew the country, I would tell you, but I don't know. Okay, so that one seemed quite straightforward. Then it can get, I think this is slightly more complicated. Okay, so this next example, you're looking at a ship, okay, and you're going to be the lessee in this arrangement. So your contract is to use the ship for a 5-year contract period. Okay, but you're aware in the world today, ships can't just go where they want to. Okay, like some shipping companies won't let their ships go through the Red Sea, for example. Okay, because there's some people there that'll fire a missile at it and so on. So, okay, so you don't, when you rent the ship, you don't necessarily get to say the route that the ship, or there might be prohibited routes, there might be prohibited cargo, there might be all sorts of things you can't do with that ship. Okay, so then it gets more difficult to make these judgments, doesn't it? And then the person you are renting from sends a ship driver. Okay, so it is quite amazing. I mean, I do some work with Saudi Aramco, the big oil and gas company, and one of the guys I was speaking to there was the captain of the ship, you know, the oil tanker. And you've got a massive oil tanker that is like 300 meters long, and there's maybe 4 people on that ship running that ship when it crosses the world. So, you know, the driver is quite an important person on that ship. Okay, so they might supply the driver. So now the lessor is providing you with the driver, the lessor is providing you with the ship, but the lessor is telling you you can't take the ship through the Red Sea. Okay, you can't take illegal substances on the ship. You can't. Okay, so there's a whole lot of requirements about things that you can't do with that ship. Okay, but you can do everything else with the ship. You can tell the driver where to drive the ship, other than where it's prohibited for the ship to be driven. Okay, so you understand the contract that we're looking at. Okay. Okay, so many decisions about how and for what purpose the ship is used are predetermined. Okay, so you're not allowed to do this, you're not allowed to do that, you're not allowed to do this with the ship. Okay. Okay, but for the rest of it, you have free reign. Okay, and the supplier is going to drive the ship. They're going to maintain the ship. Okay, and look after the ship throughout the period of your right of use. Okay, so this is getting slightly more difficult to make the judgments. When this went to the interpretations committee, okay, so it's the same 3 questions we have to answer. But the person submitting the question said there is an identified asset, it is that ship. So it's not that the ship provider can say, okay, you can use this ship today, then I'm taking that ship back, you can have this ship tomorrow. It would actually be okay if that ship needed to undergo, say, routine maintenance, that they take that ship away and provide you with another ship during the routine maintenance period. That wouldn't break it from being a lease. Okay, but if they can just provide any ship any day, then that probably would break it from being a lease. Okay, they're just providing a shipping service to you then. Okay, so these are some of the judgments. So the submitter wasn't asking about the identified asset. They said, we're happy that we do have an identified asset. And they said, yes, we can see that the customer has the right to obtain substantially all the risks and rewards of ownership, the benefits of using that asset during the period. So the question was about, in this circumstance, do they have the right to direct the use of the identified asset? Do they control the identified asset? Okay, so it's getting more difficult. It depends how much is predetermined and how much isn't predetermined. And okay, so where that line is a little bit difficult to draw. Okay, but saying you're prohibited from going through the Red Sea, saying you can't take drugs on the ship, for example, illicit drugs. Okay, so that wouldn't make it not a lease. Okay, but there is a line, okay, and it's sometimes not too easy to draw that line. Okay, so in this particular case, I think it's not too difficult to draw the line. Okay, so when the interpretations committee looks at this, they're not given a particularly difficult decision to make. Okay, but we could change the fact pattern to make it more difficult, couldn't we? Okay, and then eventually it becomes difficult to decide. Okay, so looking at this here, do you think we have a lease or we don't have a lease? We do have a lease. Okay, so almost everybody can see that we do have a lease here. Okay, so sub-question C, do we have a lease? Okay, so there are some decisions that are predetermined. That does not prevent it necessarily from being a lease. Okay, because it makes sense. If you were the lessor of the ship, you might not want your ship to go through the Red Sea right now. Okay, so you certainly wouldn't want your ship taking drugs, for example. So you can understand why there are some of these prohibitions. Okay. So that's the thought process that you need to go through in order to come to the decision about whether or not you have a lease. So here we all concluded that we do have a lease, and that was fine. Okay, so now we're going to give you a new set of facts. So the new set of facts is here on this slide, and then we're going to ask you some questions about this new set of facts. Okay, so we have a 20-year lease for a distribution center, just like a warehouse. Okay, so we've got a new lease. Okay, so the lessee is capitalizing the right of use asset. Okay, and they're adding to that right of use assets the alterations that they make, okay, like installing a sprinkler system, a refrigeration plant. So they're renting this empty building, and then they're doing some leasehold improvements, if you like, to the building. Okay, and they're capitalizing those to the right of use asset. So if you think about what they've done, they've present valued the future minimum lease payments, raised a right of use asset, raised an obligation to pay. Now they're doing some improvements. So they're debiting right of use asset for the improvements and say paying cash. So they're crediting bank for having actually made these improvements. Okay. But they're required to remove these improvements that they've made by the end of the lease. Okay, so what they're doing, and it may or may not be right, but what they're doing is they're saying, okay, I have an obligation by putting them into the building. I've got an obligation to take them out of the building at the end of the lease. So they're raising a provision liability to remove what they have put into the building. Okay, so they're crediting a liability for that, and they're also debiting that obligation to the right of use asset. Okay, so we're going to think about, is that right, is that wrong that they do that? Okay, so just to go through what they've done, they've rented an empty building, which they've capitalized as a lease. They have then done some improvements, which they've capitalized as a lease. They then have said, but hold on, the lease agreement requires that we remove these by the end of the lease. So they've raised a liability now for putting them into the building, the present value of the cost of removing them. And they've also added that to the lease. So they've capitalized that to the lease as well. And then they are depreciating the right of use asset, okay, including everything that we've added here, over the straight line method over the term of the lease. Okay, so now is everybody happy with the facts that we've got? Everybody understands what we've done? Okay, so now we're going to ask you which bits are right, which bits are wrong. Okay, so that's what we're going to be going through now. So let's run these as a poll. Okay, so is the entity's capitalization of the building alteration expenditures to the right of use asset, should they be doing that? Does it make sense that they do that? Okay, and often we start with something easy and work towards the more difficult. Okay, so what do you think? Okay, so online it seems quite popular to say yes. In the room, yes, it's the right thing to do. Okay, no, it's the wrong thing to do. Okay, so we start with something easy. Yes, it's the right thing to do. Okay, that is what we should be doing. Okay, so if we shut that one down. Okay, so then we can go to the next one. Okay, and the next one is to say, is depreciating the right of use asset consistent with IFRS accounting? So they're using straight line depreciation. Is depreciating this on the straight line basis the right thing to do? Okay, what do you think? Okay, so in the room, yes. Okay, so you have a right of use, so time is the basis on which it's going to be used up. Okay, so okay, yes seems like the right answer to that one. Well done. Okay, so we're doing something now relatively easy, so to give us a break from the more difficult stuff that we did. Okay, so going on to the next one is making a liability for the obligation to remove what you've put into the building. Does that meet the criteria in IAS 37 for a provision liability? Okay, so yes or no, let's run the poll. Okay, so when I'm thinking about provisions, I'm always thinking about what is the obligating event. Okay, so if you're going to answer yes, what is the obligating event that you have here? Okay, so who goes yes? Yeah, it's a bit split in the other room. Who's going no? Okay, so what's the obligating event? By putting it in, you're contractually required to take it out, aren't you? So the answer is going to be yes, you do meet the requirements for a provision. Okay, so it's a bit like the examples where you pollute the environment. Once you've polluted the environment, if you're legally required to restore the environment, it's the polluting of the environment that gives rise to the obligation to clean up the environment. Even though that might be 50 years out, when you've finished mining, you have to do that. By polluting the environment, that's what triggers the obligation to clean up the environment. Okay, everyone happy with that one? Okay, so next one is the accounting for the obligation to remove the building. Oh, did I do the wrong one on the previous one? So the previous one, is it right that we added it to the asset? So yes, it's right that we added to the asset, and it does meet it would have to meet the definition of the liability for us to raise the right of use asset. Okay, so I think we got through all of that. Okay, so the next bit is recognition. So this is the bit that is supposed to have been the big change because we're now going to put all leases on balance sheet. Okay, so the principle is, okay, the spin from the ISB is all leases are on balance sheet. Okay, but actually they're not. Okay, more leases are on balance sheet, but not all leases are on balance sheet. Okay, there are lots of exceptions. Okay, there are optional exceptions, and optional exceptions can have detailed rules, and we'll look at some of those detailed rules. Okay, but the main two, there's the short-term lease exception. So if your lease is less than 1 year, you don't have to put it in the balance sheet. You can if you want to, but you don't have to. Okay, so it's just, this is short-term, maybe it doesn't need to go. Suddenly the leasing industry is very interested in making short-term leases with renewal options. Okay, so then we'll look at those renewal options separately in a minute. Okay. Okay, so short term, less than 12 months. Okay, so you know, we have to think about those as being off balance sheet if the company wants to put them off balance sheet. They don't have to. They can choose just to put them on the balance sheet, and that's fine. Okay, if they choose not to put them in the balance sheet, they must tell you if they're material, okay, that they are using the short-term lease exception. If they don't tell you, they're not complying with IFRS. Okay, so if it's material and they're not telling you that they have used that option, okay, then they are not complying with IFRS in their disclosures. Okay, and then the other one is low value assets. And this one is particularly badly written, okay, because low value isn't specified in the standard as to what low value means. But in the basis for conclusions, the ISB said they were thinking about assets about $5,000. Okay, and that to me is a stupid way to write anything. Okay, like my friends in Sri Lanka say, but $5,000 is a big number for many of our companies. So now material leases are going to be off balance sheet that previously would have been on balance sheet. So this is going backwards, not forwards. But the $5,000 limit is not specified in the standard. Okay, so it's not a $5,000. That might be how many people apply it, but that's not what is said in the standard. Okay, so the company must write its own limit for what that number is. Okay, but the ISB had in mind about $5,000. Did they think there was never going to be inflation when they wrote this? Okay, how stupid can you be? Okay, because surely in 50 years' time, that number is going to look wrong. Okay, but this is standard setting. Okay, it's not a pure science. It's a social science, and social sciences come with human problems. Okay, and this is what I call human problem. Okay, but it's there in the standard. Okay, so companies will, and many do, use the low value item exception. The low value item exception is specified with regard to the cost of the asset when it is new. It's not written on this slide, but it is specified with regard to the cost of the item when it is new. You are not necessarily entering into a lease over a new item. So you need to think about the cost of the item when it's new, not the cost of the item when you enter into the lease. Okay. So this is really bad standard setting. Okay, but it's there, so we have to apply it. Okay, it's optional. So a company can choose to say, I'm not doing this rubbish. I'm just putting all leases on balance sheet. Okay, and that's absolutely fine. They don't have to use these exceptions. But I think you will find in practice, people like exceptions. Okay, so they're going to use these exceptions. Okay. Okay, then the next ones are perhaps more important because they are mandatory. So the company can't choose whether or not they do these next ones. These next ones they have to do. Okay, so lease payments based on future performance, okay, or use of the underlying asset. So say the asset is a parking garage, you know, where we park cars. Okay, so the rental agreement for that might say, you know, I'm going to pay, or the lessee must pay, you know, £10 every time a car parks in the garage. Okay, so that's based on usage. Okay, so that's not capitalized. Okay, or it could be based on revenue from the parking garage. So, you know, every million revenue you make in the parking garage, you have to pay 10% to the lessor. Okay, that's not capitalized as a lease. Okay, one of the former board members who was a board member when this was written, I was chatting with him the other day, and he says his biggest regret from his 10 years on the board was he let this rule be written, because he's seen the leasing industry now make great use of this to keep things off balance sheet. So that's quite interesting. I mean, there's a lot of compromise in standard setting. His biggest sadness from the whole time he was on the board is that he didn't fight this harder. Okay, it's not Daryl, it's some other guy. Okay, so you can see it's a social science. Okay, so many of us don't think this was a good idea, but it's there, so, and it's mandatory, so it must be applied. Okay, okay, the next one. Okay, so lease renewal options. Okay, so lease renewal options are on the balance sheet only when they are reasonably certain. Okay, I think we discussed this yesterday. What's reasonably certain? Okay, so it's a very high recognition threshold. That's what it is. Okay, there's no percentage. Okay, it's just reasonably certain, which doesn't even make sense in the English language, but that's well, partly the English language and partly bad standard setting. Okay, so that's what we have here. Okay, so now we're going to go through some examples. We're going to look at short-term and low-value exceptions. So these are optional. Companies don't have to take these, but most every company does that I see. Okay, so the group that we're looking at applies the short-term lease recognition exception. So they're choosing not to put short-term leases on the balance sheet, and they apply the low-value asset, and they specifying the low-value asset line for them in their accounting policy at £5,000. It's a British company. Okay, so they're using £5,000. The board had in mind $5,000. The exchange rate is about $1.3 to every pound. Okay, so they're not, okay, they're specifying their own threshold. Okay, so does the £5,000 threshold for the low value item exception likely contravene IFRS? So the question is, are they contravening? Is this bad or is this okay? Okay, so yes is they are contravening IFRS. They are breaking the rules. And no is, no, it's fine what they're doing. Okay, so let's do the poll on this one and let's see what people think. So this is a regulated case. You can see the UK FRC looked at this, okay, and decided whether it was good or bad. So it's not me telling you, the UK FRC is telling you. Okay. Okay, so it's quite split, yes and no. Okay, and I'm not surprised it's quite split yes and no. Okay, because we've got stupid rules. Okay, and then applying stupid rules becomes difficult, and then we'll need rules about rules and exceptions to exceptions. So this is why I don't like this type of standard setting. Okay, and in the room, who says, yes, this is bad, they're breaking the rules? And who says, no, it's fine? Okay, good. In the room, you're doing good. Okay, so what did the UK FRC say? The standard didn't say $5,000. It just said that's what the board had in mind, was some number like that. Okay, so bearing that in mind, okay, the FRC says, yes, this is a good practice example because you're telling us exactly where you are drawing the line. Okay, so the UK FRC is saying this is what we expect to see. This is good practice. Okay, assuming it's all material. If it's not material, I don't know why anybody cares. Okay. Okay, so the standard doesn't explicitly specify the threshold. Okay, the ISB had in mind $5,000 US. The UK FRC is saying you've got an example of a company saying they're using £5,000. Okay, that's absolutely fine. In fact, it's good because we know exactly where they're drawing the line. Okay, so Everybody happy with that? Okay, well, I don't know what you had for dinner last night, but today you're getting all the questions right. This is good to see. Okay, so using the short term, so this is a separate question you're getting asked about now. A company using the short term and low value lease exceptions is avoiding including otherwise material leases in their balance sheet. So this is my Sri Lankan friend. Okay. He's saying, but in Sri Lanka, these are material leases that you're now writing a rule. And if companies choose to use that rule, they will be excluding material leases from their balance sheet. Okay. So does the entity's use of short-term and low-value optional exceptions contravene IFRS? So is this contravening IFRS or is it not contravening IFRS? Material leases that would have been on balance sheet under the old rules, okay, are now off balance sheet under the new rules, according to this company. Okay, so are they breaking new IFRS or are they complying with new IFRS? Shall we run the poll on that one? So are they contravening IFRS or are they not contravening IFRS? Remember, they could choose not to do this. They could choose just to put all leases on the balance sheet, but this company is choosing not to put the leases on the balance sheet. Okay, so a little bit split outside this room. In this room, who says they're contravening IFRS? They shouldn't be doing this. Who says, no, it's fine what they're doing. The new rules say that's what you can do. The new rules say that's what you can do. This is why my Sri Lankan friends are crying. They say, what are you doing? Are you crazy? Materiality took care of this. Why are you writing stupid rules? But my German friends, they wanted these rules. Okay, so they got these rules. Okay, so is IFRS better or worse? If you're in Sri Lanka, you might be thinking new IFRS is worse than old IFRS. Okay, but it's a social science. Okay, so that's where we are. Okay, so just moving on to the next bit. Okay, so the smaller your company, the more likely this is problematic. Okay. This just doesn't want to progress for some reason. Okay, so okay. Okay, hold on. I think okay. So now we're looking at low value lease exceptions. Okay, so you have a machine that is at the end of its, or near the end of its economic life. So this machine is nearly dead. Okay, you're going to use the low value lease exception to it. At the commencement of your lease, this old asset, okay, the fair value of the machine is $4,000. So you choose to apply the low value item and exclude this from your balance sheet. You're not raising right of use. You're not raising obligation to pay. Okay, and the reason why you're not doing that is you say, I've used the optional exception, and the optional exception, I was thinking around 5,000 US dollars. This is less than 5,000 US dollars. So this is off balance sheet under my accounting policy. Okay, so does it comply with IFRS? Is this right to do this if the company chooses to do it? You're going to say, if you're the auditor, this is fine. Yes or no? Okay, if we just run the... Okay, so now we're asking the positive question. Is this right or is this wrong? Is it right? Yes. And if it's wrong, no. Okay. Okay, now we get into rules about rules, aren't we? Okay, so wouldn't it have been easier just to say, put all leases on the balance sheet. If they're immaterial, we don't care. Okay, do whatever you want with immaterial things. We do not care. We explicitly say that in IFRS. Okay, but now we're telling people something different. Okay. Okay, so it's a little bit split. And in this room, is it okay what they're doing? Yes, it's fine what they're doing. Or no, it's wrong what they're doing. Okay, why is it wrong what they're doing? It has to be based on the value of the asset when it's new. Who decided that? I mean, why? Okay, but somebody wrote that in the standard. So you must use when the asset is new, not the asset you're actually renting, what the asset would be if it was new. Okay, so rules about rules. Okay, but you have to know the rules. That's if you're going to use IFRS and you have stupid exceptions, then you need to know all the rules about these stupid exceptions. Okay, that's how it works.
Excuse me, Mike, if I can ask
Yes.
here, but wouldn't we expect from the entity to apply in the context the exact transaction, not to look into concrete IFRS, but to go back and to make a hierarchy in thinking when making the decision whether this is...
No, but here, okay, so this is a rule within IFRS. So you must apply the rule. Okay, so...
Because if it is more relevant and more...
you have to apply the standard, how the standard is written. Okay, so where you think about relevance is if I want to voluntarily change my presentation, voluntarily change my accounting policy, I can only change to more relevant. So you can argue that you want to change for investment property from cost model to fair value model, that's fine. Highly unlikely you can go from fair value model to cost model, because how would you argue that's more relevant? That's explicitly said in IAS 40. When the Chinese were adopting IFRS, basically, they had questions about, well, you know, we're on the revaluation model, can we change to the cost model? And IAS 16 doesn't explicitly say, like IAS 40 does, that it's highly unlikely you could make that argument for more relevant information. Okay, so that came to the IASB and they said, no, you must look at IAS 8, says you can only change if it's more relevant. How can you argue cost model information is more relevant than the revaluation model information? So sometimes we're using that logic to apply IFRS, but you can't override what IFRS says by saying, I would better reflect the economics by doing something else. You can't do that, okay? So you have to comply with IFRS. Doing so often requires making relevance assessments, but you can't just say it would be more relevant to do something different and do something different. Only where you're given alternatives do you make that assessment. Okay, interesting, isn't it? Okay. Okay. So entities accounting policy for use of the low value lease exception is specified on a lease by lease basis. Okay, so one lease we're deciding to use it, another lease we're deciding not to use it. Okay, so we're being inconsistent. Okay, we're just choosing lease by lease whether we're going to do this or not. Is that okay? Or must we have an accounting policy that says we exclude all low value? This is low value. We exclude all low value. Or can we just look at each lease and say, okay, this low value lease I'm putting on balance sheet, that low value lease I'm not putting on balance sheet. And those people that ask for exceptions, you deserve what you get. Okay, so now you have to know, well, can I do it item by item or do I have to do it for all items? And how would you know unless you read the standard what the answer is? Okay, so you're guessing. You can say yes or no. You're just guessing because if you haven't read the standard, you don't know what it says. Okay, so we won't run the poll because it's pointless, but you would have to guess, wouldn't you? Because it's going to say one or the other. Okay, so for this one, it says, yes, you can do it on a lease by lease basis. Okay, so your accounting policy can say, you know, I'm doing this item by item or I'm doing it for all items. But if it says item by item, I'm deciding, lease by lease, I'm deciding, that's fine. You can do that. There's nothing stopping you from doing that. Okay. Yeah, it's rule-based standard setting. It's horrible.
Sorry, because we have in IS 17 Macedonia, and the substance over form is a typical example of this kind of standard. When they made the IFRS 16, they turned the rule, and it's a rule-based. On the base of exclusion, it's a rule-based standard.
You had a rule-based standard because you did have right of use assets, you did have obligation to pay. It should have all been on balance sheet under the old standard. Okay, so we drew an arbitrary line. Then we say, okay, we don't like the arbitrary line, so we scrub that standard out. We replace it with a new standard where we're going to put all leases on balance sheet. That's where the ISB starts. Then the Germans hit with a stick. I want my small ticket item, and somebody else hits with a stick. I want this, and somebody else hits with a stick. I want that. And you have all the exceptions. Okay, so now leases are still off balance sheet. Okay, so the big spin when the standards issued, all leases are on balance sheet. And then very quietly, well, except. My biggest regret is that I didn't, you know. So you can see the problem with standard setting. It's better, and that's the main test, but it's not perfect. Nothing's going to be perfect. It's a social science. Okay, humans are not perfect. You let humans do it, it's going to be a mess. Okay, so we just want the mess to get less over time. That's the test for setting new standards, is the mess getting less. Okay, so that's basically how standard setting works. Okay, so short-term lease exception, lease by lease basis. Okay, so the short-term lease is the opposite. You can't do lease by lease. You have to have an account. So if you're looking at low value, lease by lease, you can decide. Short term, no, not lease by lease. Now you must have an accounting policy one way or the other. Okay, so you can see it's arbitrary when you get into rule-based standard setting. Okay, so this must be by class of underlying asset, your accounting policy. Okay, do you think in reality everybody knows all these little rules and are going to do it right? Okay. Okay, so here, your biggest company in North Macedonia enters into a lease for the first and only time. It has never leased anything before as a lessee. And what it's entered into a lease in is a photocopier. Okay, so for the biggest company in Macedonia, a photocopier must be fairly small, I'm thinking. That's the impression I'm trying to make anyway. Okay, and this type of lease, ownership automatically passes to this company at the end of the lease. Okay, so in the old thinking, it's clearly a finance lease. Okay, all the risks and rewards of ownership. Under the new thinking, okay, everything is, control of the whole thing is passing to the lessee at the start of the lease. Okay, and we have an obligation to make some future payments, and all those payments are going to add up to the present value would be 10,000. So in effect, we're buying a machine on credit, aren't we? I mean, that's the economics of what's going on here. Okay, so that's our fact pattern. Remember, it's the biggest company in North Macedonia. So picture in your mind the biggest company in North Macedonia. Okay, and the company just says, look, I'm not capitalizing this lease. Okay, you're just wasting my time making me do that. Okay, so now you're the auditor. Okay, so does the expensing of lease payments when they paid contravene IFRS? Are they breaking IFRS by doing this? Okay, let's run the poll on this one because I think it's interesting. Okay, so who's saying, yes, they're breaking IFRS in this room? This is illegal. Go to jail. Okay, and who's saying, no, it's fine to do this? Have you forgotten about materiality that we did yesterday? Okay, this is not material. You wouldn't even see this lease. They'd be in, you know, the roundings. It wouldn't even come up in the numbers that you see in the balance sheet. Nobody cares about this lease. Normal materiality considerations. This does not matter. Nobody cares. IFRS is explicit. You only have to apply your accounting policies to material items. This is not material. Nobody cares. Okay, so nobody cares. Not a problem here. Okay, so if you think about what the new lease standard is doing, normal materiality requirements, you can still keep off balance sheet anything that is not material. Now they're giving you rules that allow you to keep leases off balance sheet that might be material to a company. Okay, so in a way that's worse, not better. Okay, but overall, obviously it's much better than it was before. Okay, so when you fly on an aeroplane, the aeroplane is now probably in the balance sheet. The right of use is probably in the balance sheet. In the old days, there were few airplanes on balance sheet. Okay, so overall, in the big picture, it's better. But if you hunt around in the detail, you'll find some places where it's got worse, not better. Okay, particularly small jurisdictions like Sri Lanka are saying, hold on, this is worse, not better for many of our companies. Okay, it's interesting though, isn't it? So you need to understand it all. Where there are rules, okay, you have to understand the detail of the rules. Okay, rules are horrible. It would be much better if we just had principles. Okay, but people say they want rules, they can't do it without rules. Okay, social science, you can have some rules. Okay, now good luck, go apply the rules. Okay, so that's kind of how it works. Okay. Okay, so the next thing we can ask you is, does not recognize the lease in its statement of financial position. Okay, instead it recognizes lease payments as they expensed. Okay, so it's the same question, but we're just changing it slightly. We're saying, okay, they're doing this because if they didn't keep this off balance sheet, they would breach a significant covenant within a loan agreement, which would make the loan immediately payable. Okay, does that change your answer? Okay, it was otherwise immaterial, but now it's going to make a big loan current instead of non-current. Okay, so now is it material? So this is materiality you're thinking about. Now is it material? Okay, so it wouldn't matter otherwise. Nobody would care. Okay, but now if they do put it on balance sheet, it's going to breach a loan covenant, and a big long-term liability is going to become a current liability. It's going to become repayable immediately. Do you think this matters to users of financial statements now? Yes, it matters. So now it would be material. So just like I said yesterday, you are constantly making materiality assessments. You can't not be. You're not doing IFRS if you are not constantly making materiality assessments. So it looked immaterial, but if it was going to make it not breach a major loan covenant by doing it, not putting it on, then it is material. Okay, do you see that? Okay, so I think it's important to understand that. Okay. Okay, so I'll try to come back to materiality as often as I can, because some people think you can apply IFRS without doing materiality. Every single thing you do is subject to materiality, so you're thinking about it all the time. Okay, so the next thing we're going to do is look quickly at measurement of leases from the lessee's perspective. Okay, so again, you know, the idea is you just calculate the present value of the future minimum lease payments, and you're used to doing that for finance leases, and then you put the lease in the balance sheet as a right of use asset, and you raise the obligation to pay. So the mechanics of that is not new to you. You've been doing that for old leases. Okay, but now we have to be a little bit careful about all these rules. So variable lease payments that depend on an index. So the rent is increasing in line with inflation. Okay, you include that in your minimum lease payments. Okay. The exercise price is reasonably certain. Okay, there's a bargain purchase option or something like that. If it's reasonably certain, you're going to exercise that renewal option. So the lease is a 1-year lease with a right to renew for 10 years after. Okay, so now reasonable certain judgment becomes important, because you could be using short-term lease exception if it's not reasonably certain. Okay, and you're looking at 11 years if it is reasonably certain. Okay, so making that reasonably certain judgment is a big judgment in the new leasing standard. Okay, so when you're looking at that reasonably certain judgment, you need to think about, are there economic incentives that make it rational that we will exercise that option, okay, or not? Okay, and it could be written the other way. It could be a 10-year lease with a break clause at just less than 1 year, and you've got the same decision. Is it economically rational for me to exercise the break clause or not to exercise the break clause? Okay, so a lot of the big judgments are going to be around this reasonably certain threshold. Okay, and if I was a regulator, that's what I would be watching. I would be watching to see how you are implementing the reasonably certain threshold. Okay, so if you're going to say it's not reasonably certain I'm going to renew, okay, but you've got economic incentives to renew, I'm going to be very interested to understand how you came to that conclusion that you think you will be irrational in 11 months' time. Okay, because I kind of expect you to be rational. Okay, but the leasing industry is obviously going to be quite keen on trying to push the boundaries on reasonably certain. Okay. Okay, so that's a place we're going to focus some attention. And then just like you do in the current leasing standard, guaranteed residual values are important when you're trying to work out the interest rate implicit in the lease. Okay, because your discount factor is supposed to be the interest rate implicit in the lease. To work out the interest rate implicit in the lease, you have to look through the lessor's eyes and understand how the lessor is pricing the lease. Now, sometimes the lessee just can't look through the lessor's eyes. They just don't have the information to do that. So if they don't have the information, there's an exception. They can use their incremental borrowing rate. So if instead of leasing, they finance this asset using that asset as security for the loan, what would the interest rate be? Okay, so there is still that default that you can go to the incremental borrowing rate of the lessee. If you're using incremental borrowing rates, then you must explain how you come to that number. Okay, if you're doing good disclosures, you'll explain how you come to that number. Okay, so we'll look at some examples of that in a minute. Okay, and then there's unfortunately this bit where we exclude variable lease payments linked to future performance. Okay, so they're outside of the lease. Okay, so we'll look at some examples of those too. So they're going to only come into your accounting when they happen. So if it is, you're going to pay rent every time the car drives into the parking garage that you are renting from somebody, only when the car drives in does it trigger the liability to pay that. So that's when you're going to raise the liability for those types of leases. You're not going to estimate them in your future lease payments. Okay, and this is the one that the other board members very sad that they let happen, because of course the leasing industry, eyes lit up when they saw this, because, okay, so you see a lot more leases with those types of variable lease payments. Okay, then after initial recognition, we carry on accounting for the asset and liability. Okay, so again, it shouldn't be unfamiliar to you. It's very similar to what we had before. On the asset side, the right of use asset, if it's a depreciable asset, okay, which almost all of them would be, okay, you are going to be depreciating them over the lease term unless the economic life of the asset is shorter than the lease term. Okay, then you would be using a shorter period. So if you rented a machine that only had 2 years life left in it, but you rented it over 5 years, you would still depreciate the machine over 2 years, wouldn't you? Not 5 years, because you've used up the machine after 2 years. Okay, so you don't automatically default to the lease term for your straight line depreciation. You first consider, is there a way that I'm consuming the asset faster than the lease term? And if there is, you must use that faster as your depreciation. And I think we discussed already, if it's PPE, cost or revaluation, and if it's investment property, okay, cost or fair value model for the right of use asset. Okay, and for investment property, it depends on your accounting policy for investment property. Okay, so for the liability side, it's amortized cost accounting using the interest rate implicit in the lease or the lessee's incremental borrowing rate. However you worked out the present value, you carry on using that, just like you do for financial instruments, just like you did under IFRS 17. So nothing new. If you've done capitalized leases under IFRS 17, you know how to do that. Okay, so here's the UK FRC saying this is a better practice example. So when this standard was first applied in the UK, they did a thematic review of the implementation to find better practice examples and to find where people were doing worse. And then they say, okay, so these are the bad things we're finding. Here are better practice examples where we think people are doing better. The idea is to help improve the quality. Okay, so here you have somebody explaining how they calculated their discount rate. This is Tesco's, who we discussed yesterday, doing something bad. Now here's Tesco's doing something good. Okay, so, sorry. They're using the rate implicit in the lease where the lessor is a related party. So if the lessor is a related party, then they can look through the lessor's eyes, can't they? They can find out how the lessor is pricing this lease. Okay, so then it makes sense that they would be using the interest rate that is implicit in the lease. But they're saying in other cases where we can't look through the lessor's eyes, we're using our incremental borrowing rate, but then they're describing how they calculate that incremental borrowing rate. And remember, we discussed this yesterday. We don't want companies just telling us what the standard says. The standard says, okay, if you can look through the lessor's eyes, use interest rate implicit in the lease. This company is saying, we can see through the lessor's eyes when the lessor is a related party. So they're providing entity-specific information about how they determine when they can look through the eyes of the lessor and they can't. And then for the ones where it's incremental borrowing rate, because they can't look through the lessor's eyes, they're not just saying what the standard says, they're saying, well, the way we do this is we take the risk-free rate based on a government bond. We then look at the country-specific adjustment because they operate in many countries. So they're doing country-specific adjustments. And then they're doing their own credit risk adjustment on the basis of their bond yields because they've got corporate bonds. And they're making entity-specific adjustments where the risk profile is different to the group. So they're explaining in an entity-specific way how they are working out the incremental borrowing rate differently for each lease that they have. Okay, so that's what we're expecting people to do. Okay, so this is a better practice example. They're not just saying the standard says, so you can't just write your accounting policy. I use the incremental, the interest rate implicit in the lease, okay, when I can see it, and I don't use I use my incremental borrowing rate when I can't use the interest rate implicit in the lease. Your accounting policy should be explaining how you determine where you can and you can't, and how you're determining the discount rate where you are using your incremental borrowing rate. Okay, so this is the type of disclosure you're expecting to see. Okay, because they did it when they had to come up with a rate to do the discounting of the present value of the future minimum lease payments. This is just telling people how we came up with that rate, isn't it? Okay, so we expect people to do that in their disclosures. And I think that's a nice better practice example. Okay, now I've said some pretty hard things, okay, about standard setting. Now, when you see this slide, you understand why it happens. When the ISB with the FASB, the American standard setter, decided to write a new leasing standard, they start in a good place. They say, okay, if you have these lease renewal options, what we should do, so it's a 5-year lease with a renewal option for another 5 years. Okay, we should account for the 5-year lease as a lease, and the renewal option is a derivative. Okay, it's an option to renew. And the world says, no, we don't want to do that. Okay, so it's a social science. We go away, we say, you don't want to do the economics? Well, what should we do? Okay, so then they say, well, what we should do is account for the original lease and you just make disclosures about the renewal option. No, we think you should do differently from that. Okay, so what then? Maybe we should do, we account using probability weighted expected lease period. Okay, no, we don't want that. Okay, so, maybe we should use qualitative assessment. No, we don't want that. Maybe we should have most likely lease term. No, we don't want that. Maybe we should have economic incentive notion. No, we don't want that. Okay, so maybe we should have reasonably certain. Yes, let's have reasonably certain. What does that mean? I don't know. Okay, so you see the problem with social science. Okay, so all social sciences suffer this problem. Okay, so whilst it sounds we're a little bit hard on the ISB, we say, okay, you could have done better. Okay, yes, they could have done better, but this is the world they're dealing with. Okay, so you can only do as well as the world will let you do at a point in time. Okay, so if we were at 1, we would just be doing short lease term. Renewal option would be a derivative at fair value through profit or loss. Okay, we'd be telling all of the truth all of the time. Okay, but no, we don't want to tell all of the truth all of the time. Okay, so now what are we going to do instead? And that's all social science. All IFRS is a social science. Okay, so if we're not going to tell all of the truth, what are we going to tell? Exceptions. What are the rules around the exceptions? Okay, so that's how it works. So as people going to train others to implement this, okay, don't pretend that it is just telling you everything. Okay, you need to understand what it is telling you, what it's not telling you. Okay, because the users of this information have to understand what they're getting, and they have to use that information to try and fill into all of the economics. That's what it's there for. So they have to understand what is there and what isn't there. Okay, so that's basically how it works. Okay. So here are some regulatory observations about the application of the new standard. Okay, so you're required to determine the lease term. There is judgment in doing that. Remember yesterday we discussed important judgments and disclosures about important judgments. If it's estimation uncertainty, you want sort of sensitivity analysis type information. If it's not estimation uncertainty and they're big judgments important to your company, you need to tell people about those biggest judgments that you've made. So we're expecting some disclosures for some companies in that space. Okay. Okay, and the regulator is saying, look, we're seeing different approaches to accounting for leases beyond the end of their contractual term where occupation continues. So lease property law varies from country to country. So this is the UK regulator. So my lease is finished, okay, but I don't have to leave the property. I can stay in the property. Okay, so now I've gone into the period after the lease is finished. Okay, so how should I do that accounting? Okay, so this is dealing with that, and there's inconsistency in the way that people are doing that. Okay, so some people are accounting for their full rights under the law, and some people are accounting basically for nothing. They're just treating it as a short-term lease. Okay, so the regulator is saying, okay, I at least expect good disclosures about how you are applying the reasonably certain recognition threshold in this space. Okay, so you can see there's going to be judgment, and the more judgment there is to important items, significant material items, the more disclosures we expect. Okay, so you can see that case being here. So we want a clear policy, okay, about how you are doing that. Okay, so when you're looking at these lease renewal options, you're constantly reassessing whether or not you are meeting the reasonably certain threshold or not. Okay, so at the commencement of the lease, you make an assessment, you get in some economics changes, you reassess, okay, and you update if it's changed. It wasn't reasonably certain, now it's reasonably certain. So you update. Okay, so you expect that to happen from time to time. You don't have to do it every year, but if there's been a significant change in circumstance or a significant event happens, so a thing like a significant event that might happen, so you're 2 years away from your lease renewal period, and you suddenly do a whole lot of leasehold improvements, and those leasehold improvements have a longer life than your lease. Now it's reasonably certain you're going to renew, isn't it? Otherwise, why are you doing these leasehold improvements? Okay, so those are the kinds of things that might be an event that triggers a reassessment of the reasonably certain threshold. Okay, so you're going to see this in many financial statements you have a look at. You're going to see this reassessment happening when these events or circumstances change. Okay, and we'll look at that in the case study we're going to have a look at in a minute. Okay. Okay, so when you're looking at this, you have to consider all relevant facts and circumstances. Okay, and you have to try and make an assessment about whether there's an economic incentive that is going to make it highly, highly, highly likely, because highly likely means something else, remember, so highly, highly, highly likely, reasonably certain, okay, that you are going to make this renewal option trigger. Okay, so those are some of the things that you have to think about in doing that. Okay, so now the FRC provides some better practice examples. So here it's taking a company which is, I think this was John Lewis that they were having a look at, okay, and they're speaking about them and how they have made this assessment of, the renewal option becoming reasonably certain or not, and then changing the accounting for it. Okay, so here's some more detail on what they were doing. So this is their accounting policy, if you like, for distribution centers, for example. Okay, and they're saying, well, look, if there are significant break clauses or renewal options, okay, we consider whether it's reasonably certain or not to extend. And the way we make those decisions, I think particularly at the bottom, okay, we consider the value of rental. So what is our rental like to market rental, the importance of the underlying asset. If we give up this store, it's a retail store. If I give up the rental of this building, then, you know, would that be bad for my business? Okay, so you're thinking of the economic incentives that you're having a look at. How specialized is the asset? The more specialized the asset is, the more likely it is I will renew. And then the disruption to my business model of not renewing. So those are the factors that this company is saying they are considering. So notice their accounting policy is not just saying, I include when it becomes reasonably certain. It's saying, in my company, for the types of leases I have and the assets that are under those leases, this is how I am drawing the line about what is reasonably certain and what is not reasonably certain. Okay, too many times when we read financial statements, it just tells us what the standard says. We know what the standard says. Your accounting policy should be showing how you apply what the standard says. So you can see the UK FRC is saying, well, this is good. You're explaining how you determine when the reasonably certain threshold is triggered and when it is not triggered. Okay, so I think we've answered this question. Does what John Lewis is doing looking good or bad? And I think I said it's a better practice example, so I'm sure you're all going to say, yes, what they are doing looks relatively good. And the UK FRC is explaining in their thematic review that they're explaining, you know, why the company has extension options and break clauses, the types of assets that are subject to those extension options and break clauses, and the specific factors, entity specific, that it is considering in making the determination of whether or not the reasonably certain threshold is triggered. Okay. So you can see we're expecting more in the accounting policy than just telling us what the standard says. How is this company applying what the standard says? That's what we expect to find. Okay, and I think we probably, are we at break time yet? Oh no, we still have 10 minutes. Okay, so quickly to go through presentation with you. Okay, so you've got what you put in the balance sheet for financial position, your right of use asset, and your lease liability. You're familiar with that from capitalizing finance leases, so it's similar. Okay, and financial performance, okay, like finance leases of the old, okay, you're going to have interest expense and you're going to have depreciation. Okay, so that's what you're expecting to see. In your statement of cash flows, we discussed yesterday some examples. Okay, so you've got financing activities where you pay back the principal portion of the lease. Okay, and you have operating activities if you classify it as short-term off-balance sheet leases. Isn't it weird? Economically, a lease is the same whether you put it on the balance sheet or not. But your classification in your financial statements in the cash flow statement is operating if it's off balance sheet, and it's financing if it's on balance sheet. Okay, it's economically the same whether you put it on the balance sheet or not. Okay, but the accounting presentation is different. Okay, of old, you used to be able to put the interest repayment on the lease in operating rather than in financing. Daryl did IFRS 18 with you a couple of days back. Okay, that standard came out and said, when you get to apply that standard, which I'm not sure, is that North Macedonia, is that next year or late? Okay, so that isn't coming yet. That option gets taken away. You don't choose operating or financing anymore. It has to be financing when you get to do IFRS 18. Okay, but you're not there yet. Okay, so it wouldn't only be the principal portion, it would be all of it, because since the leasing standard was written, there's another standard written that is saying even the interest portion is financing. Of course it's financing. How could it be operating? Okay, but IFRS just gave you this choice. You choose. Why? Somebody wanted an exception. They got an exception. And now we've improved it slowly. We clean out the exceptions. Okay. Okay, so I think we've just answered this question. So if you are paying the principal portion of the lease back, is it operating, investing, financing? Financing. Okay, we've just said that. So it has to be financing. I think we did this yesterday. And you can see the regulator saying some people aren't putting it in the right place. Okay, and then we did this one yesterday. If you have just entered into a lease, you haven't made any payments yet, then there's no cash flow, is there? So it's not in your cash flow statement, but it would be a note disclosure for your cash flow statement about a non-cash transaction. Okay, and I think we looked at those yesterday. Okay, so looking at this one here, which we didn't look at yesterday, we enter into a right of use lease. Okay, and the right of use asset is greater than 10% of total assets. Okay, in the year we signed a new lease agreement, which is what we're talking about here, related to a new office premises, okay, new headquarters that we've got. The new lease forms greater than 90% of our recognized right of use asset. Because the entity considers the information immaterial, okay, so this is going to be a regulatory example. The entity omitted from its disclosures information relating to the additions to the right of use asset, and it omitted some total cash flow information that are specified as particular disclosure items, arguing that it's not material. Okay, and the regulator is coming back and saying, no, this is material, and here's the regulatory observation on that. Okay, and it's saying, you know, you are not providing enough information for people to understand your future cash flows. That's why those disclosure requirements are there, and you should be making those disclosure requirements. Okay, so finally onto disclosure, which I think we can get through, then we can come back after the break for the case study. Okay, so you know, the disclosures are there to try and help users understand our financial position, our financial performance, and our cash flows. Okay, so there are particular disclosures that need to be made. The UK FRC is saying it's a big problem that these lease disclosures are not being made properly, one of the top 10 problems that they're running into at this point in time. And the main problem, not entity-specific accounting policies. So remember, we looked at John Lewis, saying John Lewis was a better practice example. This is what the kind of thing we expect to see, where there are lots of lease renewal options that are material, or just even one that's material. How are you drawing the line? Okay, many companies are just telling you what the standard says. Bad, okay, go to jail, go straight to jail. But in the UK, we just say, next time, please do better. Okay, that's all we do. Okay, so that's where we are on that. Okay, so we need better disclosure about variable lease payments, because this is the new area where the leasing industry is playing their game. So of course we need better disclosure. Okay, so we need good disclosures about variable lease payments. We need to understand exactly what you are doing with your variable lease payments. When the accounting is a bit shady in terms of what you can do, okay, then we need better disclosure so we can make our own assessment of what you are doing. Okay, so you can see that coming out. The usual problems, people using boilerplate language, not entity specific, in other words. Okay, we saw some of those better practice examples of what you can do better. Not enough information about most significant judgments that are being made, so not making those disclosures properly. Okay, and then also as you change from IAS 17 to IFRS 16, your regulators get a chance to have a look at how you do that change. And the UK FRC was looking as that change happened. That was their thematic review. And they said, I can see inconsistencies between, you know, what we think should have happened from moving from the old to the new and what you've actually done. And we're going to ask you questions about those inconsistencies. So if it looks different from what we thought it would look once you had done the change, that's grounds for asking questions. Okay. Okay, so you can see the types of things that are coming up. Okay, so lease extension options, okay, is a significant judgment, but not enough information given about it. So going back again to that John Lewis example for the type of information that we would expect to see. Okay, so I think we've basically covered most of those. We'll come back after the break and do a mini case study. So I think we should be about past now. Okay, so half-hour break for tea, and then we'll come back and do this case study. Okay, so we're now going to do a case study. So all a case study is in this context, we're going to take a real set of financial statements. I like this company very much. They make my favorite food. Okay, it is a bakery that we're going to have a look at. That's all it does. It's a bakery. Okay, and they make sausage rolls that are very cheap, very salty, very fatty, very unhealthy, but very nice. Okay, so my family can't go past one of these without buying them. So they also enter into many interesting leases. So what's nice about it, it's a fairly straightforward business. It's just a bakery with lots of outlets basically in the UK, but they enter into lots of interesting leases. So that's why we have a look at it. So the first place I always go in financial statements is to look at the judgments and estimates that we discussed yesterday, the biggest judgments and estimates that a company makes. So this company, amongst its key judgments and estimates, it's telling you about reasonably certain. Okay, so reasonably certain, because it's got a lot of leases, okay, is coming up. It's providing some context about the UK legal environment for leases. So the tenants are very much protected in England and Wales. So you can't necessarily get kicked out of your building at the end of your lease. Okay, so, you know, the reasonably certain threshold becomes a little bit tricky. Okay, so they provide us with some information about how they're applying the reasonably certain threshold. I think there's room for improvement. They could do a little bit better on what they've done. Okay, but at least they are telling us, for example, at the bottom of the slide, if they have refurbished a shop within 2 years of the end of the lease, it's reasonably certain there's going to be an extension period. Okay, so under this law, if you're still occupying the building after your lease is expired, okay, it's automatically assumed that you have renewed under the old terms of the lease, basically. So they're saying, look, if we're refurbishing the ovens and whatever else we've got in the shop fittings within 2 years of getting to lease expiry, then it's reasonably certain that we're going to be renewing, because we're not going to do that refurbishment unless we expect that we are going to renew. Okay, so that's that's a good disclosure at the bottom. Okay, so, and then they're telling us that a little bit higher up the paragraph above that. Okay, so we are making adjustments. So things that weren't reasonably certain are becoming reasonably certain, or the other way around, and therefore there are adjustments. Okay, so I think that's quite helpful, and they're quantifying what the effects of those changes are. And the numbers for a bakery are quite big. I mean, you're looking at 41 million, 31 million the year before. So the effects of changing these judgments is quite, you know, big numbers. Now going to their significant accounting policies outside of the biggest judgments that they've had to make. Okay, so they're going to tell us about how they're making their lease recognition judgments. Okay, and here they're telling us, for example, on this slide, that they are taking advantage of the optional exception, where as lessee, you don't have to split between the services you're receiving and the rental. You can just treat it all as a lease. So they are taking advantage of that. Okay, so we know that. And on the right of use of assets, they're telling us, you know, that the right of use is getting depreciated straight line basis. And they are telling us over the shorter of the asset's useful life or the lease term. So there must be some leases where the useful life is shorter than the lease term. So they would be depreciating faster where the economic life is shorter than the lease term. Okay, so I think that's quite useful. and they tell us that they are testing for impairment, so that's all good. We have an understanding of what they are doing. On the lease liability side, they're telling us about these variable lease payments that don't depend on an index. Okay, so if they depend on an index, they're in the calculation. If they don't depend on an index, so for example, in some of their stores, they're only paying rental based on sales. So when I go and buy my sausage roll, a part of what I pay, they have to pay to the landlord as rent. Okay, so they're telling us about those ones. They're telling us how they are discounting their leases. They're using incremental borrowing rate. Okay, and they're giving a little bit of information, but again, I think they could do better. Okay, they're saying they're starting with UK government gilt, so UK government debt of the same maturity, and then they say they're just adjusting for indicative credit premium. So the better practice example we looked at earlier provided much more detail about adjustments. Yeah, they're telling us a little bit, but I don't think enough. Okay, so they could do better, I think, in actually describing how they work out the incremental borrowing rate. Okay, but you know, they're at least telling us the starting point and that they are adjusting for credit premium because they are more risky than the UK government. Okay, so it makes sense that they would be making an adjustment. Okay, so now we're looking at short-term leases and low-value items. So the optional exceptions, and they're telling us that they are using those optional exceptions. Okay, so they are keeping short-term leases off balance sheet. They are keeping low-value leases off balance sheet. And they are telling us about variable lease payments that are linked to sales from a shop, okay, and that they are recognizing them when the sale occurs. So in other words, when they have to make the payment. Then when I actually go to their financial statements, so this isn't translated because it's cut and paste from the financial statements. Okay, but you can see here they are telling us about their balance sheet amounts. You can see there's right of use assets for land and buildings. There's right of use asset for property, plant, and equipment. You can see their lease liability, current and non-current. Okay, so you can see what's on balance sheet, and they're telling us about the remaining maturity of the lease liabilities. So how many years out are the undiscounted amounts that have got into the balance sheet. So we can see that information. Okay, and they're telling us you know, about some changes in the right of use asset that they have from entering into new leases. Some more detail is later on. Okay, and they're telling us about modifications to leases, which have caused further adjustments to those amounts. So we're getting an understanding of how those amounts have gone through the balance sheet. Okay, here we're looking at the income statement note disclosures. They're telling us about depreciation on the right of use asset, breaking it down between land and buildings. Okay, so a leasehold land would typically be depreciated. Not always. Okay, so there is a company I do a case study on that owns oil palm plantations, and they are not they are not depreciating their land use rights. They argue they're indefinite. I don't know anybody that agrees with them, but they don't seem to be regulated on that. Okay, so they're assuming that they will get renewal forever. Okay, and I just don't think it's true under the law even. So I think they should be regulated on that, but they haven't been. Okay, but here clearly the land and buildings is being depreciated, which I think is consistent with what we would expect for leasehold rights typically. Okay, and then you're seeing in the income statement, you're seeing the interest, okay, included in finance costs, and you are seeing the expense for the short-term rentals, which are off balance sheet, and you're seeing the expense for the low-value items that are off balance sheet, and you are seeing the expense for the variable lease payments that were not included. So the ones that are triggered on when I buy my sausage roll, they have to pay a certain amount of the sales over. Those aren't getting into the balance sheet. Okay, so those are coming out in the income statement as well. Okay, so this gives you a picture for what they are doing with their leases in their financial statements. At the bottom, they're doing a roll forward of the lease liability. So they're giving us an opening balance to their lease liability. They're telling us there were new leases that came in, which increased the liability. Their lease modifications, which in this case decreased the liability. Okay, and then there's interest, which is accreting, so that's increasing, and the rental payments obviously reducing the liability. Okay, so you're getting an understanding of what's happened to their lease liability during the course of the year and why those changes have occurred. Okay. Okay, so now we're going to go to some questions. Okay, so are all short-term leases in the balance sheet? Yes or no? Okay, let's run the quiz quickly. Are all their short-term leases in the balance sheet? Yes or no? Are all their short-term leases in the balance sheet? Okay, so in this room, yes, they're all in the balance sheet. Okay, no, they're not in the balance sheet. Okay, so no, they're using the short-term lease exception. We saw in their accounting policy, they told us that they were using it. And then also we saw in their income statement note disclosures, they had short-term rental expense. So clearly they're not putting them all in the balance sheet. They are using the short-term lease exception. Okay, so they're definitely doing that. Okay, just to go on to the next one. Okay, so there are a couple of quick fire questions. Yes, what is the question? Okay, okay, so lease payments are fixed in a foreign currency but have to be paid in local currency. How to account for them? Okay, so wherever you have, so I'm just answering off the top of my head now, so we might want to think about it in more detail, but for foreign currency questions, you are always going to IAS 21. Okay, so your answer for the foreign currency translation bit would be coming from 21. I don't think you'd be thinking them of variable lease payments. You're just doing the translation through IAS 21. Okay, we can reflect on that, but for almost everything that is to do with foreign currency, okay, that foreign currency component is dealt with in IAS 21. Okay, so the only exception is where you're looking at fair value measurement, for example, that I'm aware of. Okay, so I'm thinking here, you wouldn't be thinking of that as a variable lease payment. You would just be dealing with it through translation to the currency translation, normal IAS 21 issue. Okay, thanks for the questions. Okay, so going to the next slide. So short-term leases we've dealt with. Now low-value items. Do they have all low-value leases on balance sheet? Okay, so are they in the balance sheet, their low-value leases? Okay, let's just run the poll quickly. Okay, because this is what you need to understand when you're using these financial statements. It's an option. They can choose to or not choose to. Have they chosen to? Okay, so are they on balance sheet or are they off balance sheet? Okay, so in the room, are they on balance sheet? Yes. Are they off balance sheet? Okay, so they were saying you could see disclosure, they're off balance sheet. Okay, so okay, they're off balance sheet for those. Okay, so we can go to the next question. Okay, so we're starting with the easier questions. They do get more difficult as we go. Okay, so now we're looking at variable lease payments in the form of lease renewal. Okay, so yeah. Okay, so now we're looking at variable lease payments for lease renewal options. Okay, is there anything off balance sheet with regard to lease renewal options? Okay, so let's just run the poll quickly. Is there off balance sheet? Yes, or no, is everything on balance sheet? Okay, so there were lots of lease renewal options they had to consider. Remember, this is what they gave us the big judgment disclosure about. They're saying this is one of the biggest judgments in preparing their financial statements. Okay, so is everything on balance sheet? And this is mandatory. It's not voluntary. They can't choose. They have to do what the standard says. Okay, so are they all on balance sheet? No. Okay, are there off balance sheet lease renewal options? Yes. What's the threshold? Reasonably certain, isn't it? Okay, so there'll be things that aren't meeting the reasonably certain threshold. things that are meeting the reasonably certain threshold. Okay, so some are on balance sheet, some are off balance sheet. Is there likely off balance sheet? Yes, there is likely off balance sheet. Anything that didn't meet the reasonably certain threshold, and that was one of the biggest judgments this company is telling us they have to make in preparing their financial statements. When do these things meet that threshold? Okay, so wouldn't it be better not to have a threshold and just put expected value type numbers into the financial statements? Okay, so we've done lease renewal options. So now we've got variable lease payments that are linked to sales. Okay, do you think there are future lease payments likely off balance sheet? Okay, so do you think there is off balance sheet future lease payments to do with those that are triggered only when the sale occurs? So when they're negotiating with the lessor, they could have fixed lease payments, monthly lease payments, or they could say, no, let's work out what fixed lease payments would be, and then we just set the number based on what our sales are expected to be. That'll come to more or less the same amount. Okay, so now we've agreed to, rather than having fixed monthly payments, we're going to base it on our sales. Okay, so is everything on balance sheet, or are there off balance sheet amounts now? On balance sheet? Off balance sheet? Okay, everything has to be off balance sheet in this space. So this is the worst of the exceptions. This is the one where my friend from the board is now saying, big mistake, I ever let this happen. Okay, this is the one. Okay, interesting, isn't it? Okay, so next one. Okay, so now we have got leases that we subject to. Is everything on the balance sheet? We've been through each of these individually, so we don't need to run the poll on this. Okay, there's lots of leases off balance sheet here, aren't there? Okay, short-term leases, low-value leases, variable lease payments for renewal options that aren't reasonably certain, anything to do with a variable lease payment linked to sales, which we've got. All of those leases are off balance sheet. So under the new standard, are all leases on balance sheet like the spin? No. There's still lots of leases that are off balance sheet. Okay, is it as bad as it was before? No, it's better. Okay, so it's definitely an improvement. Okay, but is it perfect? No, maybe next time, in 20 years' time, we look at the leasing standard again. Maybe then we'll get it perfect. Okay, maybe an academic will be the head of the IASB, and we won't put up with this nonsense from preparers about, okay, this is too hard, give me an exception. The exceptions are harder than not having the exceptions. That's just nonsense to me. Okay. Okay. Okay, now we're going to ask some maybe slightly more testing questions. Okay, so when we are looking at lease renewal options, and I think this one everybody should get right because we've discussed it a lot. When we're looking at lease renewal options, what is the recognition threshold? Is it greater than 0% probability, more likely than not, highly likely, reasonably certain, or certain? Which one? Okay, let's just run the vote on this because I think we'll get a very good response, I expect, on this one. Okay, so what's our recognition threshold for lease renewal options? In other words, what does probable mean with regard to lease renewal options? Is it more likely than not? Is it greater than 0%? Is it highly likely? Is it reasonably certain? Is it certain? Okay, because all of those exist in IFRS. We use all of those as meaning probable. Okay, so which one specifically applies to lease renewal options? Okay. And in the room, so who says the most popular answer there seems like D, which is reasonably certain, reasonably certain? Okay, not everybody. Okay, what else do we have other than reasonably certain? Okay, because lease renewal options, it is reasonably certain. Only when it's reasonably certain do we put it on balance sheet. Okay, everybody happy with that one? So most people there, I think. Okay, so looking at the next one, which I think you will find more challenging. Okay, because we haven't explicitly discussed this one. Okay, so variable lease payments in the form of lease renewal options we've discussed. Variable lease payments in the form of that are linked to sales. Went a little bit too fast there. Okay, nobody saw that. Okay. It's like showing the students the answer to the exam before they write the exam. Okay, so which option are we looking at here? What is the threshold that we apply for those variable lease payments that are based on sales in the shop, for example? So when you sign the lease, yes, you're going to make some payments. Okay, you just don't know how much the payment is because you don't know exactly how much sales is going to be. So what did the standard say? When do you raise the liability? What is the threshold for raising that liability? Is it greater than 0%? Is it more likely than not? Is it highly probable, like in the revenue standard? Is it reasonably certain, like the previous example we've just looked at, or is it certain? Okay, and pretend you didn't see the answer. Okay, and then we vote. Okay, even seeing the answer, wow. I'm not impressed. And in this room, reasonably certain? Certain? Okay, it's certain. Okay, so you only recognize it when the sale happens. Yeah, I think somebody's doing something else, Ross. So it's certain. Okay, so even within the leases standard, you've got different recognition thresholds, don't you? We're saying probable means certain, because we're only going to recognize where it is based on sales or where it is based on the car driving into the parking lot, for example, if that's how the rental is determined. We're only going to do it when the sale happens or when the car drives into the parking lot. Then it's certain. So why are we applying a certain recognition threshold to some, a reasonably certain recognition threshold to others, allowing people not to recognize others? It's all economically the same. Okay, so now if you don't want to tell the truth, remember when we looked at that list of things, okay, if you don't want to tell the truth, then we must write the rules for what you must tell people. And if you're using the information, you must understand the rules. So because all of these lease payments are off balance sheet, that doesn't mean that I shouldn't be adjusting for them when I'm trying to work out your future cash flows. Of course I should be adjusting for them. Okay, so you have to carry on doing that. Okay. Okay, so what I'm asking you now. So the next one is, okay, so I think these are relatively straightforward questions now. Which measurement models are available to Greg's for the on-balance sheet right of use assets that they've got? So they've put all these retail outlets. So in the shop, they've got ovens, and at the back of the shop and at the front of the shop, there's a counter, and they've got some places where they keep the pies and sausage rolls warm, basically. Okay, and all the people, the builders who come in with all their working clothes on, and my family, the only people with suits that go into that shop because we like that food. Okay, so what model is available to Greg's to account for those right of use assets? What do you think? Okay, shall we take a vote on this one? Cost model, fair value, revaluation. Okay, is there a choice? What did you come up with? Okay, so there's a bit of variation online. And in the room, cost model. Okay, cost model is actually what Greg's used, but they do have an option, don't they? They could have not used cost model if they'd wanted. They could instead have used which model? Revaluation model, because the underlying item is essentially property, plant, and equipment, isn't it? Okay, so they have a choice. They've chosen to use the cost model. Okay, so they've chosen not to do the better accounting. That's okay. They're allowed to choose not to do the better accounting. One day before I die, hopefully we'll scrap the cost model and you will have to do the revaluation model. Okay, I better live a long time, I think, if that's going to happen. Okay. Okay, so which depreciation method best reflects how they consume the service potential of those assets? Okay, is it reducing balance? Is it straight line? Is it units of production? Is it double discounting? Okay, so straight line because it's a right of use. So you're going to consume a right of use over time, aren't you? Okay, so I think everybody knows that the answer to that one is C. Okay, which IFRS accounting standard specifies how to perform impairment testing? Okay, so now to impairment test your right of use asset, where are you going? Are you using inventory standard, IAS 36, IAS 37, IFRS 9, or IFRS 16? Which is telling you how to do impairment testing? Okay, let's do this one as a vote if we can, actually. Okay, so in this room, who says we are using inventory? Who says we are using IAS 36, impairment of assets? Okay, that's the right one. Okay, so you have to use the same standard for impairment that you would be using if it was property, plant, and equipment, which is IAS 36. Okay, so everybody happy with that one? Okay. And what happens for those that are off balance sheet? Okay, so which standards are telling you to do accounting for the leases that are off balance sheet? So they're not on balance sheet. Where are you going to get your accounting? So all of those that we said were off balance sheet, where are you going to get the accounting for that? What's telling you how to account for that? And these ones are not onerous. So, you know, you're not so sad that you've entered into this contract. Okay, so let's do the poll on that one. Which standard is telling you how to do the accounting? Okay, so a little bit of variation. And in this room, where are you going to get the accounting for your off-balance sheets? Okay, the leasing standard is telling you how to account for the off-balance sheet leases. Okay, they're not onerous. Okay, so you don't have to even think about the onerousness. So the off-balance sheet ones are under the new leasing standard. Okay, just like they were under the old leasing standard. Okay, so nothing's changed there. Okay. Yeah, I think we just won out on that one. Okay, so which standard is applying to the ones that are not onerous? So we've done that one. Okay, so which one is applying to the ones that are onerous? Okay, so you didn't see that. You were supposed to be sleeping when that happened. Okay, so if they are onerous, in addition to looking at the leasing standard, you also have to look at IAS 37, because IAS 37 is telling you how to deal with the onerousness of the contract. So it's off balance sheet. You're not seeing anything until you make the lease payments. Basically, you're just doing it straight line, assuming it's even monthly lease payments. But if you are so sad to enter into this contract, okay, so Greg's has decided I'm closing this retail outlet. I'm not going to operate the retail outlet. Okay, it's an off-balance sheet retail outlet. Okay, but I've still got 2 years to go on the lease. Okay, so it's an onerous contract now. Okay, so I have to raise a provision for the future lease payments right now because I'm not going to generate any revenue from that building. Okay, does that make sense? So that would be coming from IAS 37, the onerousness of the contract piece. Everyone happy with that? Okay, so it's very much like what you have now for operating leases, so that's not new to you. Okay, so you should be happy with that. Okay. Okay, we're going a bit faster today than I expected we would be, I'm very pleased to say. So Okay, so having a look at lessor accounting now. So lessor accounting hasn't changed particularly. So you're carrying on doing what you're used to doing. So there's nothing much too new to see here. There are a few new disclosures. That's about it. Okay, so in lessor accounting, we still have to decide whether we have a finance lease or we have an operating lease. Okay, lessees don't make that decision anymore. They've got different accounting that we've been going through. Okay, but lessors still have to decide whether you have a finance lease or an operating lease. Okay, so that judgment still remains, but only for lessors. When do you have a finance lease? When the lease transfers substantially all the risks and rewards of ownership. So you still have to be able to make that judgment for lessor accounting. Okay. So finance leases are going to be basically the sale of the item on credit from the lessor's perspective, and operating leases, you're just accounting for operating rentals coming in on the straight line basis. Okay, so that's pretty much what you're used to, nothing new. Okay, so this shouldn't be too much of a surprise for you in any way. Okay, so one of the big problems or one of the big judgments lessors still have to make is whether the lease transfers substantially all the risks and rewards of ownership. So if you are a lessor with lots of leases, you're going to have to write an accounting policy that shows how you determine entity specific when this threshold is crossed. Okay, you don't just repeat what's in the standard. You say, how do I apply what is in the standard? Okay, so that's what the lessor should be doing. And obviously, there are going to be some big judgments, aren't there? So you would also expect for these lessors, if they have found it difficult to draw that line, they're going to provide you with disclosures about what the outcome could have been had the decision come on the other side of the line. Okay, so that's the kind of thing we're anticipating. We think this is going to be a major judgment still for lessors because it has been forever. It'll continue to be one. Okay, so we expect that lessors will tell us how they are drawing this line. These are the indicators in the standard. Too many companies just say these are the indicators in the standard. Okay, not good enough. How do you apply to your particular leases? That's what we want to see. Okay. Okay, so, there are some judgments that these lessors are going to be making. Classification, okay, is going to be a difficult thing still for lessors. Is it a finance lease? Is it an operating lease? That's still going to be a big decision for them. Okay, so our mini case studies for lessors. Okay, so just looking to the regulatory world to try and find these quickly. We might have discussed this one yesterday already, actually. A group consists of a parent and two subsidiaries. The one subsidiary rents to the other subsidiary. Okay, so it's a factory that's been rented from one subsidiary to the other subsidiary. So in the consolidated financial statements, okay, what do you expect? Do you expect to see investment property, or do you expect to see intangible asset, or do you expect property, plant, and equipment? Okay, what do you expect to see? Okay, so in the group financial statements, one subsidiary is renting a factory to another subsidiary. So in the subsidiary's books, it's going to be investment property. Okay, but in the group's books, what is it going to be? Okay, I think we did this yesterday, didn't we? Okay, so let's see if you remember from yesterday. Let's run the poll quickly and see what people think. So we are getting some variation. Okay, so in this room, what do you think you have? Investment property? Property, plant, and equipment? Yeah, property, plant, and equipment. It's owner occupied. Okay, so we did that yesterday. Okay, sorry, I can't remember the order. They were on the slide. Okay, so it's going to be property, plant, and equipment, the first alternative that we had. because from the group's perspective, it's owner occupied. Okay, from the group, we don't say the parent, the subsidiaries are different. We're saying it's all one thing. So we occupying our own factory. So it's property, plant, and equipment. Okay, so that was an easy one because we did it yesterday. And you can see here's the regulatory background to that question. So this is the Johannesburg Stock Exchange. They're looking at a consolidated set of financial statements. And the issuer is saying, I have a revaluation increase on property, plant, and equipment, but I'm including it in consolidated profit. Okay, so it's going in profit or loss. So that's how investment property fair value model would work. So they're saying we're using revaluation model, but now I'm putting the gain in profit or loss. So the regulator's looking at the financial statements and going, something is wrong here. Okay, I don't know what's wrong, but something is wrong. Revaluation gains don't go in profit or loss. They go in other comprehensive income. So the company is saying, I'm revaluing, okay, but they're putting the revaluation gain in profit or loss instead of other comprehensive income. So if you're reviewing the financial statements, you'd say something's not right here, write to the company what's going on. Okay, I don't understand how you're ending up with revaluation gain in profit or loss when I expect revaluation gain, if you're using the revaluation model, would go in other comprehensive income. And then the company backs and says, oh, sorry, we made a mistake. Okay, so the subsidiary was dealing with investment property, which is right. The subsidiary had investment property. The subsidiary was including the change in fair value under the investment property standard in profit or loss. Okay, so we understand it's owner occupied. So we've adjusted that piece correctly to owner occupied, but we forgot to reverse out the fair value gain. Okay, so we forgot to reclassify the fair value gain. And the group is using cost model. So what they should have done is reversed out the fair value gain and done depreciation on the investment on the property, plant, or equipment. So at fair value, they weren't doing depreciation on the investment property. Okay, but from the group's perspective, it's not investment, and the group is using cost model. So they need to reverse out the fair value gain, and they need to calculate depreciation, because under the cost model, there would be depreciation. Okay, so there was quite a lot wrong here. Okay, so the company says, okay, we see our mistake. Okay, we will go fix it. Okay. Okay, so now another example, and I think this example is quite interesting, actually. So this is the Johannesburg Stock Exchange regulator again. Okay, and COVID-19 came, remember? Okay, and suddenly, you know, everybody was renegotiating with their lessees and lessors because their cash flows were disappearing. Okay, so in their first interim financial statements, not annual financial statements, in their first interim financial statements, they had no rent concessions with any lessee. Okay, they had no contracts that they had terminated with lessees. Okay, but they knew that lessees were going to find it hard to pay. Okay, because businesses were shut down. Okay, so they knew there were going to be problems. Okay, so what they started doing is they developed their own accounting policy for dealing with this situation by analogy to IFRS 15. So they said, we're in uncharted waters here. We don't know what to do with our leases. So we're going to look to IFRS 15 to tell us whether we should be recognizing rental income or not. Okay, and under IFRS 15, they decided by analogy to IFRS 15, they wouldn't recognize any rental income. Okay, so is this right? Is this wrong? If you were the regulator, okay, you've got bigger problems than financial statements, but your job is to look at financial statements now. Okay, so this company is coming along and telling you this. Okay, so we have to think about, is this right, what this company has done? Okay, or is it wrong? Okay, so they've used the ISA hierarchy, saying the standard doesn't tell me what to do, so I'm going to develop my own accounting policy. I'm going to develop my accounting policy with reference to analogy to IFRS 15, maybe because I like the answer I see in IFRS 15, or IFRS 15, yeah, is the revenue standard. Okay, so let's break it down into a few smaller questions then to see if we can get to what we think the right answer is. Okay, so which IFRS accounting standard specifies accounting for the lessor's operating leases with its tenants? Okay, so they're operating leases, which standard is telling us how to do operating leases? Okay, let's vote on that one. Is it 9, 15, 16, 37, or 40? Okay, because this is important. If we told somewhere what accounting to do, we can't say we don't. This is the question you asked earlier. If we don't like that accounting, we can't just say, okay, I'm going to go find accounting somewhere else. You have to do the accounting that you're told to do. Okay, so which standard is giving us accounting as a lessor for our operating leases? Okay, so which standard do you think in this room is telling you? Okay, so A was, just remind me. Okay, IFRS 9. Okay, or are you looking at the leasing standard? Or are you looking at the investment property standard, if it's investment property? Okay, so there's a range of answers. The biggest one is C. Let's just go back and see what C was quickly. Okay, so I think C is saying 16. So looking at the leasing standard. Okay, so when we go to look at the answer, most of the people in the Zoom room are right. The leasing standard would tell you how to deal with operating leases. Okay, so why are we going to the IS8 hierarchy? We told how to do this, so why are we doing that? Okay, so next question that we're going to have a look at. Okay, what income recognition does that standard say we should be doing? Should we be recognizing lease payments on straight line basis? Should we be recognizing lease payments only when we cross a threshold? Should we be and is that threshold more likely than not, highly probable, reasonably certain when they occur? Okay, so from the lessor's perspective, okay, just normal lease payments. Okay, so none of the fancy exceptions. Which recognition threshold is applying? Okay, or is there no recognition threshold? We just recognize them, okay, under A on the straight line basis. Okay, let's take the vote on that one. It'll be interesting to see what people think. Okay, so we're getting some on A, some on B, some on C, some on D. Why does this have to be so complicated? Okay, why don't we just tell the truth all the time? It's simple, isn't it? But no, we want not to tell the truth, then we have to decide what we're going to tell people. Okay. Okay, and in this room, who says A, just straight line it all? Okay, who says no, there's a recognition threshold, probable, highly probable, reasonably certain, certain? Okay, quite a few non-participants. Don't care, had enough, I want to go home. Okay, so A is the right answer here. Okay, so the recognition threshold is essentially greater than 0%. Okay, so, oh, but different now for some other lease perspective, different recognition threshold, just spread it, whatever it says in the rental agreement, straight line. Okay, interesting, isn't it? Which is applying a greater than 0% probability recognition threshold. Okay, so if we've recognized, so that the lessee hasn't paid us, so we've recognized the rental income, so we've got a receivable, don't we? Okay, in applying the accounting standard, that's what we've got to. Okay, so how do we test that receivable asset for impairment? Okay, so remember what the lessor was doing in the example in their financial statements. They weren't recognizing anything. They were just saying, I'm not going to get anything. I'm not recognizing anything. But what is the standard saying they're doing? No, you should recognize straight line. Okay, so they should have recognized something, but now they've got a receivable asset. So we need to test the receivable asset for impairment, don't we? Okay, so which standard is going to give us the impairment testing? IFRS 9, IFRS 15, IFRS 16, IAS 37, IAS 40. Oh, if only we just told the truth. Okay. Okay, let's take a vote on that one. So which standard is specifying the impairment testing that we need to do for this one? Okay, so in this room, let's just see how we're going. Who says IFRS 9, I think was the first option? Okay, that's the right option. Okay, because impairment testing you kicked into IFRS 9. You've now got a receivable, a financial instrument. So you should be doing IFRS 9, or in your case, you'd be doing IAS 39 if you're not a bank. So, okay, so you're using the financial instrument impairment testing. This is complicated, isn't it? Okay, not telling the truth is complicated. We've all got friends that don't tell the truth, okay? And you just watch them when they're trying to keep their lies consistent, okay? And they're clearly catching themselves out. That's IFRS, okay? If we don't just tell the truth, we have to know all the different rules for the different stories that we tell. Okay, so there we go. Okay, so what should have they done? They shouldn't have not recognized anything. They should have recognized it using the leasing standard, which would have given rise to a receivable, which would have been impairment tested under IFRS 9, okay, which would have, if it's IAS 39 incurred loss model, IFRS 9, expected credit loss model. Okay, so maybe we get to a similar answer. Maybe we're going to write it all off. I don't know. Okay, you'll have to apply the standard to work out if that's the truth or not. Okay, but you can't just say, I don't like the requirement, I'm writing a new requirement. If there's no requirement, you get to write the requirement. But if there is a requirement, you must apply the requirement that you're given. Okay, so was the issuer justified in applying the ISA hierarchy, developing their own accounting policy? Okay, let's vote on this one, yes or no? I think someone's having a laugh now. Okay, are they justified in doing this? Can you just disregard IFRS and write your own accounting policy because you know? Okay, so clearly they are not justified in doing this. The regulator must tell them, go redo your financial statements. Okay. Don't you think? Okay. Okay, so there we go. I'm a bit worried about the vote. Okay. Okay, so clearly you can't just write your own accounting policy. You must apply the standard if there's a standard that applies. Okay, and even if that through a long roundabout way gets you back to the same point, okay, then you have to do that. Okay, but there is one other thing that's different, okay, and that's, remember, if it's not material, we don't care. Okay, so if it's not material, we don't care what you do. Okay, you don't have to apply your accounting policy to immaterial things. So if you're a big company and you have one asset that you're leasing out to somebody that's fairly small, we don't care what you do. Okay, it's not, IFRS doesn't care. Okay, in that instant. But here we're assuming this is all material, so it does matter. You must apply the appropriate standard. Okay, so here you can see the regulator coming back and saying, hold on, Okay, there's particular requirements that tell you how to deal with this. Okay, so paragraph 81 of IFRS 16 explicitly tells you what to do. Then it tells you you go into IFRS 9 for the impairment testing. Okay, so, you know, you are told how to do this. There's interim reporting that's giving you requirements. Okay, so, you know, you can't use IAS 8 to get out of doing this. It's inappropriate to do that. Okay, so that's the story there. Everybody happy? Okay. So which standard specifies disclosures for a lessor's operating leases? Okay, we won't run the poll on this. Okay. So which standard is going to specify disclosures? What do you think? Okay, so the leasing standard should be telling you, and if it's investment property, then the investment property standard is going to tell you. But investment property only applies to lessors that are leasing out land and buildings. So if you're leasing out motor vehicles, you're not in IAS 40. Okay, then you are in IFRS 16. Maybe I should update that to reflect that. Okay, this is the last thing we're doing before lunch. So let's have a look at this example. So, you know, the UK FRC is always trying to help people do better. Okay, very nice, kind regulator, I think. Okay, so what they're saying here, better practice example, okay, where you have these most significant judgments that we were discussing yesterday. Okay, so, you know, it was difficult. This is a big lessor, and it's difficult to decide whether I have met the criteria for it to be a finance lease or for it not to be a finance lease. And we're renting out vehicles. Okay, that's the standard that we're in. Okay, so it is quite difficult to make the judgment. They have made the judgment. They've decided they're on one side of the line or the other side of the line. Okay, but there's disclosures that they're making under paragraph 122 of IAS 1. So they're saying, look, this is the key judgment that we had to make. We had to decide whether these leases transferred substantially all the risks of rewards of ownership. Okay, it was a difficult judgment. It makes a big difference to our numbers. It's one of the biggest judgments we had to make in doing these financial statements. Okay, the effect on our financial statements of the judgment we made was as follows in the second column. And then in the third column, if we had concluded differently, that would be the financial effect of doing that. Okay, so it was close. It was hard to decide which side of the line we're on. We're on this side of the line. That's the effect. If we were on that side of the line, this would have been the effect. Okay, now it's clear to you as a user, you can make your own assessment of which side of the line you think they're on, and you've got enough information to be able to make adjustments to their financial statements on the basis of the information that they have disclosed to you. Okay, so that's really good disclosure. So I think it is good that the UK FRC is highlighting this as a better practice example. Have you ever seen a set of financial statements that does this? A set of financial statements says there was one big judgment we had to make. Okay, it was very significant to our financial statements. We came out on this side of the line because this is how we made the judgment. Had we come out on the other side of the line, it would look different. This is the main effects that would be different. Okay, so does everybody understand what we've done here? Okay, so I think this is very good disclosure. Okay, so this is the kind of entity-specific disclosure that you should be seeing for paragraph 122 to 124 of IAS 1 that we discussed yesterday. Okay, how often are you seeing that disclosure? Never. Okay, why? Why? This is the most important thing I need to know when I look at this set of financial statements. Okay, but these disclosures are generally done poorly. Okay. Okay, so you can see the kind of thing that they should, so go out and encourage people to do the right thing. Okay, you don't just say what the standard says. Okay, you make the entity-specific disclosures that help people understand the effect of the judgment you have made. Not for every judgment, but just for the most significant judgments that you made in preparing those financial statements. It is rare to see proper disclosure in this space, and it shouldn't be rare. Okay, some regulators like the UKFRC, like the JSC, they're pushing people to make better disclosures. It will get better over time. Okay, but this is generally poorly done in the world. Okay, so, and if it had been key measurement assumptions rather than most significant judgment not involving measurement, then you would expect to see sensitivity analysis. And you would expect to see sensitivity analysis on reasonable possible changes to the key inputs to that measurement. And it doesn't have to be done as in the form of a sensitivity analysis, but equivalent information must be disclosed if you choose not to do sensitivity analysis. So what is a reasonable possible change in the underlying assumptions that are key? Okay, and what would the effect of that be? We're not seeing that disclosure. We should be seeing that disclosure. It is, in my view, the most important disclosures that there are in IFRS. Okay, so if you can encourage people just to do that better, I think there would be a big step up in the quality of financial reporting. Okay, so we've got through this a little bit earlier, so you're getting a slightly longer lunch break today, but I'm happy to answer any questions anybody might have. Okay, I do just put in here the sources where I've looked for the information to do this with you. Okay, so there is recent regulatory updates. So that's where I went to try and look for examples to discuss with you. Okay, happy to answer any questions that you have. And then it is lunchtime. Any questions? Up here. Okay. Okay, we will try to keep the polling questions up a bit longer. Okay. Okay, so we do try and break the polling questions down into very broken down questions, so it should be relatively quick to respond. Okay, but yeah, if we're doing it too quickly, and maybe what it is we announce the question, then it takes a while to, okay, so we'll, in the afternoon, we have got time, okay, so we will do that, okay. And in the afternoon, we're doing income taxes with you, okay, and I know you're not doing income taxes properly in North Macedonia, so the afternoon session is important, okay, so we will go through that this afternoon with you. You're not alone in the world, okay, lots of people aren't doing it properly. In fact, few people are doing it properly. Okay, that's why we can use other jurisdictions' regulatory rulings to show you what you should be doing that I know you're not doing. Okay, any questions? Any questions from the Zoom room? Feel free to ask. Otherwise, you get a slightly longer lunch break. Okay, and after lunch, we're going to be doing income taxes with you. Yes.
One economy, solid level, everything needs to be eliminated, to be zero. But now not the case.
So, sorry, I don't understand the question. So you're saying in implementing IFRS 16, the new leases standard?
Yes.
In one economy?
Yes. For example, if we consolidate all the enterprise there, everything should be eliminated, should be zero, assets and liabilities. But now it's
so,
the case.
so are you, okay, so I think I understand what you're saying. So if when you apply IFRS 16 for the first time and you bring the leases into your books, will the right of use asset equal the liability? Okay, so there are some transitional provisions which I haven't discussed with you. Okay, so when you apply a new standard for the first time, in theory, IAS 8 says you should go back and redo every lease as if, you know, as if you had done the accounting under the new standard from when you started. Okay. Then there's transitional provisions that say, okay, that's going to be too hard for you, so you can do something easier. Okay, and the something easier that they let you do, just off, I haven't read this just before I came, okay, but if my memory serves me correctly, it is basically you can calculate the lease liability today and recognize the right of use asset equal to the lease liability. Okay, so in that case, if everybody used that transitional provision, it would come net null. Okay, but you don't show it null, you show the asset and you show the liability. Okay, but always when you apply a new standard for the first time, look at the transitional provisions. Okay, the transitional provisions are there to make life easy. Some of these leases can be very long, asking people to go back forever to work out, okay, too difficult, so you get some practical expedient. And if my memory serves me correctly, that is one of the practical expedients in IFRS 16. Okay, I'll check and confirm, but I think that is the case. Any other questions? Yes.
Excuse me, regarding the application of IFRS 16, please, can you tell us about the treatment of when the, for example, when you have a real property leasing agreement for a period, for example, of 10 years, which is then subleased to another legal entity.
Right.
What is the treatment to the, for example, a person that's now is in the position of leasing lesser
And
lease.
SC.
Yeah.
Okay, so you're speaking specifically about property. So IAS 40 is includes IAS 40, the investment property standard, okay, includes investment property where you own the building and you rent it out to other people. It also includes, and it might be an option that you can do this rather than you mandatorily have to do it. I'd have to check that. Okay, but you can also include leasehold interests. Okay, so if it would otherwise meet the definition of an investment property because you're renting it out to other people, you can account for that leasehold interest under the investment property standard. Okay, so in that case, that's probably what the middleman will be doing. Okay, so you're renting it in,
Yes.
and you're renting it out. The rental in is an operating lease. The rental out is an operating lease. You can account for that leasehold interest as an investment property at fair value through profit or loss. If that is your accounting policy for investment property, is fair value through profit or loss. Okay, so in fact, if my memory serves me correctly, and I would have to check this, I think you can even decide on a lease by lease basis. I can say this one I'm going to treat as investment property, that one I'm not going to treat as an investment property. Okay, but I have to check that, but my memory serves me correctly, you can do it on a lease by lease basis. Okay, so that if the people that want to do good accounting, that's what they will be doing. They'll be treating the leasehold interest at fair value. Okay, and including it in investment property. Okay, any more questions? It's good for me to have my memory of the standards checked every now and again as well. So thank you for the questions. Okay. Okay, is there one online here? Okay, right of use for land normally should be depreciated. Yes, it normally would be depreciated. Okay, but you could have a right of use of land. So the lease of the land might have a bargain purchase option at the end of it. Okay, so then would you depreciate the right of use or wouldn't you depreciate the right of use? So the bargain purchase option you're going to exercise. So then it's probably an indefinite right to land, isn't it? Okay, so you're not necessarily going to be depreciating it. You have to ask yourself, am I consuming the service potential of the asset or aren't I? Okay, so if it is the type of lease where you're renting it for 5 years, there's a bargain purchase after. In economics, you're just buying the land on credit, aren't you? Okay, so then you're probably not depreciating the land. Okay, but the example I was describing was in a jurisdiction where the foreigners were owning the land and the local law had changed so that foreigners couldn't own land and that lease renewal rights wouldn't be renewed for foreigners that had long-term leases over land. and the company carried on not depreciating, assuming that it would always be renewed. And I think that was just contrary to the economics. Okay, so I think in that case, even if they were right originally not depreciating the land, it felt to me they were certainly wrong once the local law had changed, which took away their right to renew. Okay, so, but you see wrong stuff in financial statements quite often, I think. Okay, so what other questions do we have? Okay, so additional costs for arrangement of the offices. Okay, so we spoke about leasehold improvements. If this is leasehold improvements, then we were capitalizing leasehold improvements. Okay, so I'm not sure what additional costs might be, but if the additional costs are in the form of leasehold improvements, you would be adding them. Okay, so we'd have to think about what the nature of other costs might be before we could answer that question in more detail. So if you send that through, we can look at that in more detail. Okay. Okay, any other questions? Yes.
Can I ask you one more question? Should a tax is paid for the rent, such as VAT and VAT, be included in the value of right of use assets and the long-term liability, because the companies that are not registered VAT payers in Macedonia do not have the right to deduct this type of VAT?
Okay, so I think that's exactly the distinction that you want to draw. So if you were going to get the VAT back, then obviously it shouldn't be included in the right of use asset, because, okay, but if you're not going to get it back, then it feels to me that you would include it because you're not getting it back. Okay, so that to me seems what the answer would be. Okay.
I had this kind of question I had received, and somebody in Macedonia that have prepared financial reporting on the consolidation level, on the group consolidation level from the mother company, they received a instruction that this kind of VAT that is not deducted must to be excluded from the.
So where are they going to put it?
I don't know. I asked them to give me the instruction to check that.
Yeah.
It was very unusual.
Yeah, that sounds, well, it's an interesting question, shall I say. I would like to know why they felt that way, and then we can look at the reasons and see if there's some logic in the reason. Okay, but if you're not a VAT vendor, you can't get the VAT back, then why wouldn't it just be, you know, included in the asset, okay, and in the liability? Okay, it might overvalue the asset, so then your impairment test might kick in. Okay, so you might need to think about that. Any other questions? I do get nervous just answering questions on the fly, shall I say, because you're not giving me a chance even to think, and I'm answering immediately. Okay, so, you know, take account of that when you look at the answer, which is why we say send us the questions in advance, then we can think about the answer better and discuss it with one another. So we'll deal with the written questions. Do you want to kick off with something, Daryl?
Sure.
Oh, sorry. So whilst Daryl's getting ready, I'll just deal with the question that we had on adopting the leasing standard for the first time. So you're going from the old standard to the new standard. So there is a whole appendix to IFRS 16, Appendix C, that you're going to have a look at. So in Appendix C, you're given two choices as the lessee. You can do full retrospective, so you can go back and restate your leases as if you had always used the new standard. Or if you want, okay, you can do an adjustment to your opening accumulated profit. So don't restate past years. Do an adjustment to opening accumulated profit. And the amount of that adjustment, you're given a few options about how you can go about calculating the amount of the adjustment. On the liability side, it's more just present value, the future outstanding cash flows under the lease. The asset side, there's more than one variation. The one variation is more or less just recorded at the amount of the liability, like I said before the break, but there could be some adjustments to that number if you have prepaid rentals or something like that as well. So there are a few things to consider there. So the detail is in Appendix C. You want to go to Appendix C of IFRS 16 to see the detail. There is a number of different ways. One is full retrospective application, as if you have always applied the new standard. And the other main way is basically to do it from the beginning of the year of adoption. Okay, the year that you first used the new requirements, adjusting opening accumulated profit. Okay, calculating the lease liability. Then one of the alternatives for the asset side is to make that equal to the liability, provided there's nothing strange about the way the payments have been made, like prepaid or in arrears up front. So that's just finishing that question. Then over to Daryl.
So the question I'm going to answer now is just the revenue question that we started to touch on yesterday. And I said it had come through online, but I wanted to read it properly before I answered it. And it's actually quite a nice question because it falls very nicely within a lot of the topics we were talking about yesterday. And I'm going to start with the specific example that we finished with, which was the one about the audit fees. And we said, what happens with an audit fee? The auditor comes in, the auditor does some work for the audit. Let's say we get to the auditor's month end. Now they've got to decide. They have not yet billed and they have not yet finished the audit and delivered an audit report. So our question that we tried to deal with yesterday is, can the auditor recognize revenue? And we had to decide whether this was over time or whether this was point in time. Point in time, when I deliver the report. Over time, we said the first rule we have to think about is, does the person who is having the fee done, who's having this, so the client customer, do they have control of the audit? We said, no, they don't. So that's the first cross that we put in. The second one we said, then if it's not control, we said, does the auditor create, and this is the full test that was on the screen, does the auditor create something unique that the auditor cannot take away and use themselves? So if you get fired as the auditor 75% in, can you take all the work you've done and take it to another client and use it at another client? No, you can't. So then the test says, in that case, if you cannot, as the provider of the service, use it, then you go to the next test, which is, can you still demand payment? And the answer is, yes, I can demand payment. Then I treat it as earned over time. Okay, what does that mean over time? It means that the auditor will look at their work each month. They will recognize revenue for the work they've done. Go forward a month, whatever work they've done, they recognize the revenue. The billing is just a by the way thing. Okay, so that was the question we answered yesterday. In the context of the question that came through last night, it was one that we actually touched on quite a bit, which is, what happens if I buy that hole in the air? I buy the apartment on the 5th floor in a building that hasn't been built yet. Okay, so now let's ask the same questions. Do I control the apartment? No, I don't, because it's up there in the air. It's just, so as the buyer, I don't control the apartment. The builder controls the apartment. Okay. That would point me towards the idea that I will only take possession when control is passed to me at the end. So when I get it right at the end. The second test, am I consuming it as it is being built? No, I'm going to have this asset at the end. So that would also point to the idea that this is at the end. Now we get to the test we just talked about on the audit firm. Okay. Is it a unique asset that the construction company can do nothing with? Okay. If the apartment is identical to every other apartment in the block, then the construction company can say, well, if you don't buy it, I will simply sell it to somebody else, because it's exactly the same as every other apartment in the block. And in that case, I say that I wait all the way to the end, and on the day that title transfers, that is the date that it actually is sold to you, the buyer of the apartment, and that is the day I'll recognize revenue. But if it is unique, okay, so I, the buyer, said, okay, I want your 5th floor apartment, but I want you to put pink marble in, and I want you to have 1 big bedroom instead of 3 bedrooms. I'm going to change this to my own terms. I've customized it in such a way that it is unique to me. The construction company can't do anything with it because nobody else is going to want pink marble with 1 bedroom. In that circumstance, you move to the next test, which is, can the construction company demand payment? And if the construction company can demand payment, then the construction company is building the apartment for me specifically because it is bespoke and they can demand payment at any point in time. So all long and short, if you are building a standard flat or a standard apartment that looks like everybody else's apartment, you wait until legal title transfers. In other words, the building is finished. If you are building an apartment that is specific to the requirements I have, then the transfer happens as you complete each bit of work on that particular apartment. And hopefully that answers the question that we got online. And maybe one further point, the person online, I think was from Armenia, also said that the law says that title only transfers when the whole apartment block is finished. So title doesn't transfer, even if my apartment is finished, title doesn't transfer until everything is transferred. From the perspective of the way we think about this, as long as title transfer is a mechanistic thing, that's irrelevant. What I look at, the more important thing is, what are these, how is this work done? Is it over time? Is it at point in time? The registration, if it is just mechanistic, that is just a bit of paperwork that has to be done. That doesn't affect the date.
And then just going back to the one that I was talking about, a separate question came about whether when you use IFRS 16 for the first time, whether you would be producing 3 balance sheets or just 2 balance sheets. So if you have taken the option in the transition to do full retrospective restatement, as if I have always been applying the new standard, then you would have the 3 balance sheets. But if you've taken the option just to adjust opening accumulated profit in 2025, then you would only have 2 balance sheets, not 3 balance sheets. Okay, so it depends a little bit about which of the transitional provisions you have taken, because if you have taken the transition provision to adjust opening accumulated profit in 2025, you will not have restated 2024. So your opening balance sheet won't have changed for 24. Then there's another question about the type of lease that has an automatic extension if not terminated, and then what lease term should you be using? So here you're going to be applying the reasonably certain recognition threshold. So if it's reasonably certain that you're going to not terminate, that you are going to continue, you're looking at the longer period. If it's not reasonably certain, then you're looking at the shorter period. And that reasonably certain judgment is the big, difficult judgment. And there's a case where it would be applying. Do you have another one?
No more from us.
Okay. So then there was whether it would make a difference if rent is paid monthly, quarterly, semi-annually to your leasing under IFRS 16. So you're present valuing future cash flows. So the timing of the cash flow does matter in terms of what the present value of that cash flow would be. So in terms of raising the right of use asset and the lease liability, okay, if you're discounting back 10 years, the number's going to be smaller than if you're discounting back 1 year. So obviously, in terms of the actual amount that you get, so not in terms of the mechanics of the accounting, but in terms of the amount that you're going to raise as an asset, different discount periods would cause you to have a different amount because of the time value of money. and the discount rate that you're using is the interest rate implicit in the lease, if you can determine that, and if you can't determine it, the incremental borrowing rate for the lessee using that asset as security for that loan. Okay, so I think that's everything that I had on leasing. There was at least one that came back to what we were doing yesterday that somebody asked for clarification on. And you remember we were discussing residual value yesterday, and we said the regulator, the JSE, had regulated a company where it was using the revaluation model, and it had said the residual value is higher than the carrying amount, so they're not depreciating. Okay, and we said they got to that conclusion because the way residual value is defined, it's defined as what would the asset sell for today if it was already as old and in the condition I expect it to be in at the end of its useful life. And in almost all circumstances, that you would expect to be lower than the carrying amount of the asset today, when the carrying amount of the asset is under the revaluation model, which is essentially fair value today. Okay, so in those cases, you would always be depreciating. The question that came now is more, well, what if I'm using the cost model? So if I'm using the cost model, my carrying amount could be low and my residual value could be high. And if that's the case, there's nothing to depreciate. You would stop depreciating. Okay, so if your residual value is higher than your carrying amount, there's nothing to depreciate. Okay, so when we're telling all of the truth, when we're doing the revaluation model, the economics isn't going to reflect that. But if you do the cost model, well, then you're doing rubbish accounting and you will not depreciate even though you are consuming the service potential of the asset. But you're using the cost model, so don't set your expectation too high. Okay, so that's, I think, all of the questions that hadn't been answered that I have. I think all the other questions that I've answered, I'm sticking with what I've said so far. So I haven't had a reason to change the answer, shall I say. Okay, any question anybody wants to ask just before we lose Daryl? So whilst there's still two of us. Okay, you're all free to go, Daryl. Thank you. Thank you for coming in to do that. Okay, can everybody hear me okay? So income taxes is an area of accounting where, you know, there is a huge need for improvement. So it is an area of accounting where I expect a lot of people aren't doing it quite right. So it is an area all around the world where there is need for significant improvement, shall I say. Okay, so just to remind you, we're looking at IFRS, and we're looking at IFRS at the beginning of this year, 1st January 2024. We want in this session to try and develop further your ability to train others to understand better IAS 12. The problems aren't particularly with current tax. The problems are more with deferred tax, but there are some issues around current tax, so we will have a look at those as well. And particularly, we want to try and help people understand better the judgments that need to be made in order to apply these standards. So some of it will be quite straightforward, but some of it is really quite tricky. Okay, so the first thing we want to do is understand current and deferred tax. So IAS 12 is not covering all taxes. It is only covering income tax. And income tax is where you have a notion of a taxable profit against which you are going to apply a tax rate. So you need to have some income minus some costs, some expenses, and the net of that you're applying a tax rate to. Okay, so that's, if that is the type of tax that you have, then you're applying IAS 12. Some regulators, and I think some of the examples I've got in the slides will show that there are instances where people are applying the income tax standard to things that aren't income tax. So the regulator's saying, this isn't income tax, you shouldn't be applying this standard, you should be applying maybe the government grant standard. Okay, so you can see there's a problem about determining whether the right standard to apply is the income tax standard. So what we're going to go through with you mainly today is where the income tax standard does apply, then this is how it should be done. Okay, so we need, in the scope of this standard, those taxes that are based on a notion of taxable profit. That is what we are having a look at. Okay. So in the UK, you can see, for example, the regulator said there's some research and development credits that are being given to companies, and some companies are accounting for those as part of income tax. They're not income tax. Okay, so you shouldn't be doing them in income tax. So get them out of income tax and into government grants, basically. So that's an example of where you see the wrong standard being applied to something. Okay, so there's an example. Okay, so now coming back to current tax. So all current tax really is the number you get when you fill your tax return in. Okay, so a very rough way of referring to it would be, when you fill your tax return in, what is the number that I get for tax for the year? That's current tax. Okay. Okay, so it's relatively straightforward, except where we have, say, uncertain tax positions, because tax acts tend not to be clear. So when it's unclear how much tax you actually owe for a period, because the tax law is not clear, okay, then we have to work out, well, how do we do the accounting for things that are not clear in tax law? Okay, so this becomes a little bit complicated. And IFRS never used to tell us how to do that. It was just silent. So you had to do something, but you weren't told what to do. So it went to the Interpretations Committee, and they came up with what I would just describe as an interesting interpretation. And I mean interesting in the most English meaning of that word, okay? But it is what it is, so you have to do what it says, basically, because that interpretation is now part of IFRS. Okay, so you have to do what the interpretation says, even if you thought if I wrote the interpretation, it would look completely different from that, how that interpretation is written. It's endorsed by the board, it's part of IFRS, we have to use it now. Okay, so current tax is generally well understood and reasonably well done around the world, except for the odd bit around the edges. The place where it gets bad is with deferred tax. Okay, so deferred tax, just in principle, is basically a timing difference. Okay, so the tax authorities in many jurisdictions will say to you, if you build a factory that's going to create jobs, then we'll let you write the factory off quickly, much more quickly than you're going to depreciate it for accounting purposes. So by letting you write it off for tax purposes quickly, you're paying less current tax. Okay, but they're not saying that, they're not donating money to you. They're going to take the money back, because if you get a tax deduction of $1 million this year, let's say you've got no depreciation this year, but you get a tax depreciation of $1 million, and the tax rate is 30%, you're paying 300,000 less tax this year than you would otherwise pay. But let's say next year you now have the accounting depreciation, but now the tax authority looks at you and says, hold on, I gave you the deduction that you're taking for accounting expense this year, last year. So take your accounting profit, add back the $1 million, and pay tax on $1 million higher than what your accounting profit is. So they're taking the money back, aren't they? So it isn't a donation, okay, when they give you deferred tax, accelerated tax allowances, it's a loan. And that's what IFRS makes you reflect it as. So IFRS says, if you're paying less tax just because of a timing difference, okay, don't pretend that you don't have tax expense. You've just got deferred tax expense rather than current tax expense. So if we debit expense and credit liability, We've raised the liability for the tax we know we're going to have to pay in the future in respect of the accelerated tax allowance, which has made our current tax smaller this year. So if your tax rate is 30%, then your tax expense, if there are no permanent differences, no unutilized tax losses, no other complications, if your pre-tax profit, your accounting profit is $1 million, then your tax expense is going to be 300,000. The fact you don't pay any tax because they're letting you off the current tax this year, you're going to pay it next year. You're not going to pretend you don't have tax expense this year, even though you're not paying tax this year, because you're going to pay the money back next year. Next year, if your accounting profit's $1 million, you're going to pay, you know, 600,000, not 300,000, because you're going to have to add back the accounting depreciation, okay, to your accounting profit and pay tax on the higher number. Okay, and then tax rates change. So remember, everything in IFRS is an estimate. So if I raise the deferred tax asset this year, when the tax rate is 30%, so the government, I would have otherwise paid 300,000 current tax, but the government said, no, you built a factory, you can have a deduction of $1 million, so I don't pay tax this year because my taxable profit is now nil. Okay, but then next year I'm going to pay tax on $1 million more than my accounting profit. Next year, if the tax rate changes to 20%, when I pay the tax, I'm only going to pay 200,000, not 300,000, because the tax rate has fallen. And if the tax rate goes to 40%, I'm going to pay 400,000, not the 300,000 that I was, you know, let off paying in advance, if you understand what I'm saying. So the liability is just an estimate, and the estimate is measured on the basis of substantively enacted tax rates. So substantively enacted is a judgment, because in different jurisdictions, substantively enacted kicks in at different times. In South Africa, where I'm originally from, the Minister of Finance stands up every year, does a speech, says, next year the tax rate's going to be whatever percentage. The tax rate is always that percentage the next year. So in South Africa, when the minister speaks, that's substantively enacted. In the US, okay, they say it's not substantively enacted until it's enacted. The minister can say whatever they want, okay, but that doesn't necessarily become the tax rate. Okay, so you have to make a judgment about your jurisdiction. When in your jurisdiction does it become substantively enacted? But your judgment should be the same as your judgment and everybody else's judgment. Okay, so it should be consistent within the jurisdiction. Okay, interesting. Okay, so we measure current tax and we measure deferred tax, for that matter, using substantively enacted tax rates. Okay, but that's a judgment about when something becomes substantively enacted. Okay, so deferred tax is basically this temporary difference, this timing difference between accounting expense and tax expense law. The law is just different. Okay, and the way it's described in accounting, we'll go through in a minute with you, but we speak about the tax base of an asset, for example. So if you bought your machine for $1 million, okay, then its carrying amount is just whatever it is in your books at. You've depreciated it at 100,000 a year, you 3 years in, so it's 700,000. That's your carrying amount. Your tax base is the future tax deductions you're going to get for tax depreciation. So if for tax depreciation it's been written off over, let's say, 4 years, it's getting written off at 250,000 tax depreciation per year. So when you buy the asset, your tax base is 1 million, the future tax deductions you expect. After 1 year, you've had 250,000, so the tax base is 750, the future tax deductions you expect. After 2 years, it's 500,000, because you've now had 2 years of 250, so there's another 2 years of 250 to go. Okay, does that make sense to everybody? So that's the terminology we're going to use to make the discussion that we're going to have, because that's the terminology as it is in the standard. Okay. Another place that deferred tax assets arise is with tax losses. And the rules around tax losses are very different from jurisdiction to jurisdiction. So in the UK, where I live now, in South Africa, where I originally come from, you can carry forward tax losses indefinitely. So if you make a tax loss this year, I can't use it next year, I can't use it the next year, I can't use it the next year, I can't use it. Okay, I carry it forward until I make taxable profit, and then I can offset it against the taxable profit to work out the amount that I have to pay tax on. Now, it varies jurisdiction to jurisdiction very much. So interesting, I was doing work in Poland a few years back, and there you can carry forward only 5 years. Is Macedonia 5 years too? I think I saw North Macedonia 5 years. But in Poland, it's a little bit different. In Poland, you can only carry forward 5 years, but you can only use 50% of the tax allowance in any carry forward year. So if you carry forward to the next year, make a huge profit, you can only use half of your tax loss brought forward. You can't use the whole tax loss brought forward. Okay, now North Macedonia, does that restriction apply? 3 years you carry forward, and you can utilize it in full as soon as you can. Only in COVID year. Okay, so there we have. Okay, so you get different, so you have to understand what the rules are in the jurisdiction that is doing the accounting. Okay, and there can be all sorts of restrictions around it. Okay, and the recognition threshold, because you're now speaking about recognizing deferred tax assets. So the recognition threshold for recognizing deferred tax assets, specifically when they relate to tax losses, is you have to have convincing evidence. Okay, so this is a new one. We've had highly probable, reasonably certain, more likely than not. Now you need convincing evidence. Okay, so what the biggest accounting firms that I've looked at have said about convincing evidence is they say it means at least more likely than not. So the lowest threshold that they're going to allow you to get away with is more likely than not, greater than 50%. But you can have 60%, 75%, whatever you think convincing evidence is. Okay, this is another weird one in the standard where they just decided to write it differently again. Okay, why? Well, they special. I can't really explain that. Okay, so it's a little bit different. Okay. And then we recognize deferred tax for all differences between the carrying amount and the tax base, except, okay, so of course we have to have some excepts, okay. So you may be aware of Pillar 2 income taxes. This is a fairly new thing. So around the world, I think the UN held the discussion, and it was generally decided that a minimum tax around the world should be about 15%. Taxes shouldn't be lower than 15%, okay, so but, you know, it's a free world. You can agree or you can disagree. Your country can agree, it can disagree. It's up, you know. So some countries sign up to the Pillar 2 regime and some countries don't. Okay, so the countries that do sign up to the Pillar 2 regime, the faster you signed up, the bigger the benefit to you. So Japan understood this very quickly. I think they were the first to sign up. The UK had argued for this, but then forgot to sign up as quickly as Japan. So they weren't first in the queue, they were a little bit behind in the queue. But it matters because when those extra taxes get collected, the timing at which you joined Pillar 2 can determine whether you get the additional taxes or some other country gets the additional taxes. Okay, so it's quite interesting. So if you think about just a basic situation where you've got a parent and a subsidiary company, so let's say the subsidiary company gets taxed at 10%, okay, and the parent company hasn't signed up to Pillar 2 taxes, okay, and there's no fellow subsidiaries, no fellow associates, that's the total structure of everything, then the tax rate is going to be 10%. But if the parent company has signed up to Pillar 2 taxes, the country has signed up to Pillar 2 taxes, 10% will get paid by the subsidiary, and the parent company, I don't know, in the UK or Germany or Australia or wherever it is, okay, is going to say, oh, your subsidiary only paid tax at 10%. Okay, we are Pillar 2 country, they have to pay tax at 15%. We taxing you 5% of your subsidiary's profits. Okay, so the thinking is that countries will then just up their tax rates to at least 15%, because why would anybody in a 10% regime, okay, not take the 5% for their country? Just let the UK or Japan or Australia take 5% for the profits that were earned in your country. So that's the thinking, that this problem won't last long because minimum taxes will just rise to 15%. Now, whether that happens or not is another story, okay? Because, you know, governments try to think of tax, but, you know, companies and others do things differently, and nobody gets to tell everybody what to do. So, you know, there's a certain amount of freedom in the world, okay? Okay, so the time Pillar 2 gets really interesting is, say that parent company didn't sign up in the example we were looking at to Pillar 2 taxes, that country didn't sign up, but that holding company had a subsidiary in another country, and that subsidiary in the other country did sign up to Pillar 2 taxes, that country did. Okay, then this subsidiary sitting over here that might not even know about this subsidiary over here, this subsidiary paid at 10%, the parent wasn't in a Pillar 2 country, this subsidiary is in a Pillar 2 country, the government of this country can come and say to this subsidiary, you need to pay 5% on the profit of the tax of that company, okay, which isn't even in your group, because your group is you and your subsidiaries, okay? So you can see, okay, so sometimes you don't know until the knock hits the door, okay, about whether you have to pay more taxes or not, okay? Okay, so you can see, for that reason, it was argued that we shouldn't create deferred tax for Pillar 2 taxes, because it's too complicated. People won't know until somebody knocks on the door that they have to pay taxes for some unrelated company somewhere far away, okay? So for that reason, there is an exception to creating deferred tax for Pillar 2 taxes. There's no exception for current tax. For current tax, you have to raise it. But for deferred tax, there's an exception. Okay, and then also, on initial recognition in a business combination of goodwill, there's an exception, because your goodwill, typically, you're not going to get a tax deduction for using up your goodwill. Okay, but in some jurisdictions like Poland, you do get a tax deduction for goodwill. Okay, so in Poland, this exception wouldn't apply. But in most countries, there's no tax deduction with regard to goodwill assets. Okay, so if there is a tax deduction, and there are very few countries, Poland's the only one I'm aware of actually, where you do get a deduction for goodwill, okay, then in Poland, this exception doesn't apply. But everywhere else that I'm aware of, okay, you calculate the carrying amount of your goodwill. The tax base of your goodwill would be nil because there's no future deduction for the goodwill asset, except in Poland. And then there's an exemption. You don't have to provide for deferred tax, or you mustn't provide for deferred tax on that goodwill. Unless you're in Poland, then you must provide for deferred tax because the exception wouldn't apply. Okay, so you can see, like everything, there's some exceptions that you have to be aware of. Okay, and the last one is just in a business combination. Okay, sometimes on initial recognition, it affects neither taxable profit nor accounting income. So it's something that's essentially permanently going to be a permanent difference. Then you don't have to raise deferred tax on that. Okay, so maybe the easiest way is just to look at some regulatory examples. So this is the South African regulator. Yes, the South African regulator. And they're looking at a couple of companies here, and they're saying, oh, I see the bottom bullet point. You're using the revaluation model, but you're not raising deferred tax. Why? Okay, you're increasing a carrying amount without a corresponding change in a tax base, so your carrying amount's higher than your tax base. Why aren't you raising deferred tax? Okay, so you can see there, error, you should be raising deferred tax. Okay, another example that they found was There were some interest rate swaps that were getting accounted for at fair value. So the company's doing the appropriate fair value accounting for the interest rate swap, but not calculating deferred tax, when it might be that the tax authorities are only going to tax when it becomes realized, not when the fair value change is recognized in accounting. So there's a timing difference between accounting and tax again. And again, the South African regulator is saying, I see you accounting for these derivatives at fair value. That's great. That's what we want you to do. Okay, but the tax authorities aren't going to tax those until they're not realized. Okay, so I expect I would see deferred tax. I'm not seeing deferred tax. Okay, so again, the company says, sorry, okay, we forgot to raise the deferred tax. We should have raised the deferred tax on this. Okay, so there are queries. This is the UK FRC now saying, you know, we raised queries where it was apparent that there was non-recognition of deferred tax. So they were focused on deferred tax assets, actually. Okay, so this is more of an offsetting question, where the requirements for offsetting weren't necessarily met, but there was no deferred tax asset. So it's a similar thing, though. They're looking for non-recognition. Okay. So how do we measure a deferred tax liability? Okay, so interestingly, for deferred tax assets and deferred tax liabilities, there's no discounting. So my analyst friend who deeply regrets the story I told you earlier about leases, okay, he wrote an article the other day that said, be very careful when you see, particularly in these jurisdictions like the UK, South Africa, where you can carry forward tax losses indefinitely. So there's some very big deferred tax assets, particularly after a pandemic or a financial crisis. Some companies have very big deferred tax assets. Okay, so those deferred tax assets are undiscounted, which means they're overstated. There's no present valuing. They would be smaller if it was present valued. So be careful about counting that number. That's an overstated asset in terms relative to its economics. It's not worth as much as it's shown in the balance sheet because the cash flow might be many years out. And if the cash flow is many years out and it's not present valued, it's clearly overstated. And even in the UK, we had inflation of 10% or 11% a year or two ago. So you can see discounting back 10, 11%, very quickly, that number becomes a lot smaller, doesn't it? So no discounting of deferred tax assets, no discounting of deferred tax liabilities, no discounting of current tax assets, no discounting of current tax liabilities. Okay, so that's different from the economics. So when you're using the numbers, you need to understand that they're different from economics. Okay, so substantively enacted is always a little bit difficult. We've discussed that already. The last one is differential tax rates. So some jurisdictions will have the first million profit you make, 10%. The second, up to 10 million, 15%. Above 10 million, 30%. Now working out the tax rate you should raise deferred tax at means you have to work out what your future expected effective tax rate is going to be. So you have to forecast what your taxable profit in the future is going to be and work out the effective tax rate in those future periods and use that effective tax rate, okay, to measure the deferred tax today. So that's quite difficult. Okay, so do you have progressive tax rates or a flat tax rate? Okay, don't have to worry then, okay, because you're relieved of that very difficult judgment that needs to be made, okay. Then there's some specific rules that were written, and I wish these rules weren't written, but they are written. So the first one, they tell you if you are revaluing non-depreciable, which is typically land, so if you're revaluing land that you're not depreciating, you must measure tax as if you were going to sell it. So you measure deferred tax using the tax consequences that would follow from the manner in which you expect to realize the carrying amount of the asset. So if you've got land, okay, the only way you can recover the carrying amount of land is through selling the land, okay, or renting it to other people, but renting it to other people wouldn't consume its service potential. Its service potential would stay the same. You don't depreciate the land. So the only way you can use up the land is to sell it to somebody else, and then you no longer have an interest in the land. So why we had to write this, I don't know. There's no other answer. That was the answer before they wrote this and after they wrote it. It's no different. Okay, but some people obviously needed it explained to them. Then the next one is really a little bit odd. Okay, so the next one says there's a rebuttable presumption. So you presume it's this way unless you rebut the presumption because it's another way. So if you have investment property that you're carrying at fair value, okay, then you presume you will recover it through sale. Okay, so the tax rate that you're looking at would be the tax rate that would apply on the sale of the land. Okay, so that's the tax rate you're going to be using, unless you're going to recover substantially all through renting it out to other people. So if I build a shopping mall, for example, maybe I'm going to rent it out to other people and recover through rental income. Okay, substantially all. Okay, then I can say it's the rental income recovery that the tax rate that applies to the rental income is the tax rate that I would use rather than the tax rate that applies when I sell the building. So many jurisdictions have a different tax rate that applies to capital gains when you sell and to normal profits like rental income, trading profits. Do you have the same or a different tax rate? The same. Your life is easy. Okay, so this is another problem you don't have to worry about. Okay, because you're always using the same tax rate. Okay, that's not true for many jurisdictions. Most jurisdictions have a different rate for capital gains tax as they do for normal trading operations and so on. And then all this becomes quite important. For you, it's not going to matter because it's the same rate. So it doesn't matter whether you're recovering through sale or whether you're recovering through use because the same tax rate is going to apply. Okay, so again, your life is made a little bit easier. Okay, so that is lucky for you. Okay. Okay, so this we've discussed already, so it wouldn't matter to you particularly, but you must reflect in your measurement the tax consequences that follow from the manner in which you expect to recover the carrying amount, sale or use, but in your case, it would be the same tax rate for both that you are saying. Okay, so I think that's, so here you can see where there are different rates that apply to capital gains and things that are not capital gains. Okay, people get confused as to which rate they should be using, and the regulator has to visit them and say, I think you're doing your accounting using the wrong rate. Okay, so you can see here some examples of where that is the case. We won't spend time on it because it's not too relevant to you. What will be relevant to you is the presentation of how you present the income tax expense. And the complication comes from two places. In the income statement, you've got, your first page going to profit or loss, and then you've got another page dealing with other comprehensive income. So the tax expense or tax income should be following the presentation of the underlying item. So if the underlying item is in profit, then the tax expense should be in the income statement. If the underlying item is in other comprehensive income, then the tax effects should be in other comprehensive income. And if the tax effects are, if the item is split between profit and loss and other comprehensive income, then so should the tax be split between profit or loss and other comprehensive income. So if you think of, a bank carrying some debt of its own debt at fair value, there's a fair value change. So then it has to isolate, is any of that change due to its own credit risk changing? The piece that relates to its own credit risk changing goes in OCI, and the rest goes in profit or loss. So the deferred tax effects must be split between OCI and profit or loss. If you're using the revaluation model, okay, and you revaluing an asset, okay, then the revaluation will be going through other comprehensive income. If you then impair the asset, part of the impairment is going to be a reversal of a prior period revaluation. That reversal, that deferred tax effects and other comprehensive income, and the rest is going to profit or loss. The tax effect on the piece that goes to profit or loss must go in profit or loss. Okay, so you have to keep track. If you want OCI, you can have OCI, but then you have got other complications. If you want where you remeasure your own liabilities, you want to present separately the bit that's due to your own credit risk and other comprehensive income, there's no logic for that. Okay, yes, you can have it if you want. You hit the ISB on the head with a stick for long enough, they'll give you an exception, but now you work out the deferred tax and allocate it as well between OCI and profit or loss. Okay, so be careful when you ask for exceptions. If you are unlucky enough to be granted your exception, there will be a lot of complication that comes with your exception. Okay. Then the other presentation thing to think about, oh, and sometimes items like if you issue, say, new shares, for example, even convertible debt might be a better example, and then some of the costs of issuing the debt get allocated between equity and liability, and there's deferred tax effects, then the deferred tax effects, to the extent they relate to the equity, must go directly in equity, and to the liability must go into the liability. Okay, so it can be directly in equity too in some cases. The other issue in presentation to think about is offsetting. So the rules are quite clear, I think. You must offset your tax asset against your tax liability when these two conditions are in place. You have a legal right of offset and you intend to settle on a net basis or simultaneously. So if both of those requirements are in place, you would typically have to have the tax with the same tax authority, an asset and a liability. Okay, because if they're with different tax authorities, you're not going to be settling net, are you? Okay, you wouldn't have a legal right of offset. So it has to be with the same tax authority, for example. Okay, so just looking at some of the regulations. So if you look at the UK FRC, you know, they're saying sometimes things are popping up with income tax and OCI. It's not clear why they should be in OCI or why they are or aren't in OCI or directly in equity. It just seems strange, unrelated to the accounting for the underlying item. Okay, and they ask questions where they see movements in deferred tax that haven't been recognized directly in equity when the underlying item is recognized directly in equity. Okay, and then sometimes you see no tax effects in other comprehensive income, but you're putting items in other comprehensive income. That seems unlikely. Okay, so again, they will raise questions in those situations. Okay, and then obviously with regard to offsetting as well, they will be raising questions. So I think we've discussed that on this slide as well. Okay, so you can see the regulators in South Africa, the regulators that are reviewing financial statements in the UK are asking lots of questions about tax accounting. Okay, the accounting for income taxes in financial statements is raising questions. People don't seem to be following the IFRS IAS 12 requirements properly. Okay, so you can see this company restating its comparatives when it realizes that it hasn't done the offsetting requirements properly, for example. Okay, so what I'm going to do now, okay, so we've shown you some of the problems. We're now going to go through a basic example just to make sure that you can calculate and then do the tax rate reconciliations that would be presented about these different things we're having a look at. Okay, so on the last day of December 23, we buy a machine, we pay 500,000 for the machine. For accounting, it's 5 years straight line, nil residual value for depreciation. Accounting profit before depreciation, coincidentally, for each of these 5 years is 400,000 per year. So it's 400,000, but we're also going to have 100,000 depreciation. So accounting profit is going to be 300,000 each year. For tax, though, our tax rate is 30% and depreciation is only over 2 years, not 5 years. So tax depreciation is faster than accounting depreciation. So clearly we're going to have a timing difference. Okay, so that's what we're going to try and illustrate. Okay, so if we look at this example now, okay, what do you think, let's do the two pieces separately. What do you think current tax is in 2024? If you had to calculate current tax for 2024, in other words, when this company fills its tax return in, how much should it be coming to at the end of 2024 that it owns? Okay, so we can't run the quiz because the quiz is asking two questions. Okay, so how much is current tax? Try and discuss with the person next to you. How much is current tax? Okay, shout when you think you've got the answer. Okay, just if you're in the Zoom room, you can just type it in the chat if you have the answer. Anyone? Okay, so we've got takers at 45,000. Does anybody agree with them? 45,000? Okay, 45,000. Okay, so what have you done? You've said, I've taken profit before depreciation was 400,000, but tax depreciation is 250,000. So I've minus 250,000 because the asset is getting written off for tax purposes over 2 years. So 500,000, 250 per year for each of the first 2 years. So 400,000 was profit before thinking about depreciation, minus tax depreciation of 250. That's leaving you with 150. 150 times by the tax rate of 30%, okay, is giving you 45. Okay, does everybody agree? 45. Okay, so that's current tax. How much is deferred tax? Okay, we need to send that to Daryl. So it's off the topic that we're on now. We're going to stick to the topic we're on now. Okay, shout when you've got an answer. Okay, and I saw in the Zoom room, some people were coming up with 45. That's good to see. Okay, so in this room and in the Zoom room, are you now thinking about how much is your deferred tax for 2024? One way of thinking about it, how much have you been allowed to underpay taxes by this year? If the tax law had been exactly the same as the accounting, you'd have paid a different amount of tax this year. So how much have you been allowed to underpay your tax this year? Because that's effectively the loan that you've got, isn't it? Okay, so what number are you getting? Okay, so we're getting, is that a 75,000 that I'm seeing? Okay, so it's the end of 2024. 75, any agreement on 75? Okay, no agreement on 75. Okay, so what number are you getting? 45 again. Okay, agreement on 45. Who agrees? 45? Everybody? 45 is the right answer, isn't it? Okay, you should have had depreciation of 100. You've had depreciation for tax purposes of 250. So you've got accelerated tax allowances of 150, haven't you? So you've underpaid your taxes this year in effect by 150 times by the tax rate. Okay, so you've underpaid in effect by 45,000. So your total tax is going to be 90,000. What is your accounting profit? 300,000. 300,000 times 30% is 90,000. Do you see that? Okay, so you're just not pretending that the loan that you got is letting you off tax permanently. You're saying, no, there is tax. Okay, I just don't have to pay it now. That's all you're saying. So current tax is 45, deferred tax is 45, because you're going to pay that 45 back at some point, aren't you? Okay, and for those of you that do it the kind of way IFRS would explain it, your accounting carrying amount has gone from 500 to 400, but your tax base has gone from 500 to 250. So 400 carrying amount minus tax base of 250 gives you a difference of 150, doesn't it? So 150 times by the tax rate gives you 45. 45 is your liability. Your liability was nil. Your liability is now 45. So you've got an increase in 45 in your liability. So you have expense of 45. Does that make sense to everybody? Okay, so let's do the next year. Okay, so at the end of 2025, what is your current tax for 25? The same, 45. So what's your deferred tax? The same. The same. In the balance sheet? Double. So in the balance sheet, it's 90 now, and in the income statement, it's 45. So thinking the way IFRS thinks through it, so we started carrying amount of 500, it reduced to 400, now it's reduced to 300. You agree, depreciation. Tax base has gone from 500 to 250 to nil. Okay, so we've got 300 compared to nil, carrying amount compared to tax base, difference is 300, isn't it? Times by the tax rate, that's giving you 90, isn't it? You were 45 at the beginning of the year, you're now 90, so you've gone up by 45, haven't you? Okay, so your expense is 45. So what's your total tax expense? 90 again. 45 current plus 45 deferred. Okay, so in the third year, what is your current tax? Okay, so I'll get takers at 120. Does everybody agree, 120? Okay, so accounting profit before depreciation was 400, minus tax depreciation is how much? Nil, because you fully depreciated for tax. So current tax is going to be 400 times the tax rate. So that's giving you 120, isn't it? Okay, so now what about deferred tax? 30,000 lower. So you're saying 30,000 income, and in the balance sheet, 60,000. The balance sheet is 60,000 and the income statement is 30 income. Okay, do we agree? Okay, so let's go through it. You started at 500, you've minused 100 in the first year, 100 in the second year, 100 in the third year. So you're down to 200, aren't you? And for tax, you started at 500, minus 250, finished. So it's 0. 200 compared to 0 is 200 difference. 200 times by the tax rate is going to give you 60. So 60 is the right answer in the balance sheet. Okay, the balance sheet was 90. It's going from 90 down to 60. So you now have 30 income, don't you? Does that make sense to everybody? So what's your total tax expense? Total tax expense? 90. What's accounting profit? 300 times by the tax rate gives you 90. Do you see what's happening? Okay, so your tax expense is being, if there are no permanent differences, no unrecognized deferred tax, tax expense isn't pretending that the government is giving you money. It's saying we're going to recognize the tax expense when we recognize the accounting profit. Okay, the fact they tell us we can pay less tax than we would otherwise have to pay, that's fine. We've got we've got a liability. We owe them that money in the future. And you can see how they get it back, because next year, in our example, another 30 is going to reverse. And the next year, another 30 is going to reverse. So for years 3, 4, and 5, current tax is going to be 120 and deferred tax is going to be 30 income. Does that make sense to you? So then our balance is going to go from 90 to 60 to 30 to 0. Okay, does that make sense to everybody? Okay, so what's hard about deferred tax? Why do most analysts ignore deferred tax? Surely they don't. Warren Buffett says it's his, I think, second or third biggest source of financing. The money that the government allows him not to pay in tax when under accounting rules, it feels that the tax is due because the tax rules are different from the accounting rules. You look at Berkshire Hathaway, Warren Buffett's company, when Trump changed the tax laws last time, by far his biggest income item, by far, like 9 times bigger than the rest of the income put together, was reducing the deferred tax liability because the estimate had changed. Okay, so watch, whenever Trump gets in again, he's threatening now, I think, even to scrap taxes. So you'll see Berkshire Hathaway have a huge income item again, okay, from taxes going down. Taxes don't always go down, do they? Sometimes taxes go up. If taxes go up, the adjustment's going in the opposite direction. Okay, it's interesting, isn't it? Okay, so you can do deferred tax. That's what you've told me now, and I agree with you. Okay, so here's the example we've gone through. You can see every year we are ending up in this example with 90 income tax expense. Okay, but the split between current and deferred is different in the different years. The first 2 years, 45 current, 45 deferred. The next 3 years, 30 income in deferred and 120 expense in current. Everybody happy? Okay, so why do people find this difficult? Okay, I don't understand. Okay. Okay, that was our calculation. Okay, so the next thing we're going to do is, okay, so maybe it was just too difficult. It was too easy because it was a non-financial asset. So if we go to a financial instrument, is it any different? So this financial instrument is a debt instrument, so it's like a bond, okay, that we are invested in. So we're holding it as an asset. So it's a government bond or a corporate bond, okay, that we are invested in. And the corporate bond or government bond has only 2 cash flows. We pay 100,000 upfront to buy the bond. And how many years is it? 15, 16, 17. 3 years later, we're going to get 106,000. Okay, so that's it. Those are the only cash flows on this bond. Okay, but the government is only going to tax us when we realize the profit. Okay, and there are 2 ways that you could, there are 3 ways you could be accounting for this bond, but the 2 ways we're going to look at, okay, is fair value profit or loss or amortized cost. Okay, so I've calculated the fair values for you just to make it quicker, but you could easily calculate the fair values, couldn't you? Because you're just discounting back. So if you know that the future cash flow is 106, that's the only other cash flow there is. So if you discount back 1% 1 year, 10% 2 years, 2% 3 years, okay, so what's happening? The market interest rate is changing. Okay, the market yield on this bond is changing. Okay, because interest rates change. Interest rates don't stay the same. Okay, so if you're doing fair value accounting, you're discounting the future cash flow back at the market yield, aren't you? So if you went to sell the bond to the person next to you, they're not going to say, oh, I understand you paid high price for the bond. I'm going to pay you a high price when I buy it from you. That's not how it works. Market interest rates have changed. I'm going to pay you fair value today. And if it trades in a bond, the market will be working out those numbers. You won't have to do the calculation. So in our example, you can see we start at a fair value of 100,000. We go down to a fair value of 87. We go up to a fair value of 105. And then tomorrow it's going to be settled. So fair value is 106,121, which admittedly is wishing away counterparty credit risk, which isn't realistic. But yeah, that's basically what I am saying here. Okay, so if we're doing amortized cost accounting, we won't be using fair value. We can just ignore fair value. So amortized cost accounting is just to pretend we bought a bond for for 100,000, and it's going to go up by 2% every year. Okay, until it gets to 106,121, 3 years on. So add 2%, then add 2% to the accumulated amount, add 2% to the accumulated amount. I'm presuming everybody can do amortized cost accounting, am I right? Okay, so the effective interest rate in this bond at initiation is 2%. So I'm going to accrete interest, so it's going to go from 100 to 102. And then it's going to go from 102, whatever 2% of 102 is up by, to the next year, until it gets to 106,121. Everybody happy? Okay, our tax rate is 30% in our example, and gains and losses are taxed when they are realized. So not on the accounting fair value change, but when they turned into cash, they taxed in this jurisdiction we're looking at. Okay, so what do you think? How much is deferred tax income or expense in 2025? Remember, we entered into the instrument on 1/1/25. Our year end is December 25. So do we have deferred tax income or do we have deferred tax expense if we are using cost model accounting? What do you think? If we're using cost model accounting, what do you think? So you're going to accrete interest. You're going to accrete interest at 2%. So interest accretion is going to be 2%. So your carrying amount's 102. Your tax base is future deduction. How much is future deduction? 100,000. That's what you're going to get a tax deduction for when you sell it. Okay, so carrying amount is higher than tax base. Is that going to give you a liability or an asset? Liability or asset? So you're making accounting profit that they're not going to tax you on now. When you think in accounting terms, I could be taxed now. But for tax purposes, they're not taxing me. They only tax me when it's realized. Are they letting you off tax now in timing terms? Yes. Okay, so you owe them the money, don't you, in your accounting mind? Okay, so you're going to create a deferred tax liability. So if you create a deferred tax liability, it's going to be a deferred tax expense, isn't it? Is everybody happy? Everybody happy? So it's no more difficult if it's a financial instrument. It's just, is the carrying amount the same as the tax base? No, the tax base is future deductions. In year, whatever it is, just going back here. Okay, in year the first day of 2028, it's going to cash in. So I'm going to receive 106,121. Okay, but the government's not going to tax me on 106,121. They're going to tax me only on the extent to which that is above what I paid for, and I paid for 100. So they're going to tax me on 6,121, aren't they? Does that make sense? In the rules as we've written them here. Okay, does that make sense to everybody? Okay, so you can do this. Okay, so how would and then here I've done the calculation for you. So in accounting terms, you're going to be accreting interest, and that's going to get it up to 106. For tax purposes, the future deduction is not changing. It's always 101. So you can see how the liability will grow. Okay, the liability is the accreted interest times by the tax rate. So on the day before it cashes in, your liability will be 1,863, won't it? Everybody happy? Okay, you understand how this works? Okay, so how would it be different if you were using fair value accounting? So if you were using fair value accounting, your fair value at the end of 2025 is 87,703. So your carrying amount would be 87,703. What is your tax base? What is your tax base? Still 100,000. Okay, so what is your temporary difference? The difference between those two numbers. So how much is your deferred tax? And is it income or is it expense? So the difference between the two numbers is 12,297. So apply the tax rate, you've got 3,690. So is the 3,690 income or expense? Income. Okay. Because your carrying amount is now lower than your tax base. Okay, so if you were getting taxed on the fair value change as it happened, the government would be paying you money now. You wouldn't be paying the government money now. You would be reducing your current tax, wouldn't you? Okay, does that make sense to you? Everybody happy? Okay, so now it is going to be income. It's not going to be expense. Okay. And it would work its way through. Okay, so just like we did the other one, that's the end of 25, but 26, it would go up to this number. Okay, so there's a big change. So now you're going to have a liability instead of an asset. Okay, and when you get down here, you still at liability. Okay, it's 1836, just like it was. Okay, over here, you come to the same number at the end because tomorrow it's turning into cash, isn't it? Okay, is everybody happy? You can do this. Okay, so what happens if you're not on the asset side, you're on the liability side? Okay, so we've discussed you were invested in somebody else's bond as an asset. What happens if it's the bond you've issued? So you're on the liability side, not the asset side. How different do you think that'll be? If you were to so you could be using fair value, you could be using amortized cost. So the numbers are exactly the same. So what would be different? The numbers would be the same because fair value of the asset is the fair value of the liability. Amortized cost on the asset is the same as amortized cost on the liability because we're ignoring transactions costs. That would make it slightly different, actually. So it's the same logic, but what's going to be different? No, it's the, yes.
It's about the liability, then should be recognized as taxable expenditure.
Okay, so I think you're saying the right thing. So if under the asset side we were ending up with income, on the liability side we're ending up with expense. Okay, and if on the asset side we were ending up with expense, on the liability side we're going to end up with income because it's equal and opposite, isn't it? Yeah, that's the only difference. So if you can do assets, you can do liabilities. Okay. Everybody happy? You know how to do deferred tax now. Okay, it's not difficult. It's just a timing difference. That's all it is. Okay, it's not difficult. I think people hear deferred tax, and they have this, I don't know, this fear shock. Why? It's just a timing difference. Okay. Okay, so I think we're on top of that now, so we can do something more difficult. Okay, so this is an investment property example. I actually don't know if we need to go through this really because you don't have differential tax rates. So for you, it's always going to be whatever the difference is times by the tax rate. You're not going to have to worry about whether it's the capital or not the capital tax rate. So for you, this is actually quite easy. Okay, so I might actually skip over this, okay, because it's not going to be difficult for you. But this is another asset where there's two types of measurement. Okay, there's fair value model or there's cost model. Okay, so the answer is going to depend on whether you're using cost model or you're using fair value model. Okay, so basically, if you're using fair value model, I always draw these graphs, by the way, because I battle to get it right without the graph. Okay, so I'm buying an asset, an investment property for $1 million, and I'm getting tax deductions, and I just draw my tax deduction line. So by the end of 2040, okay, so it must be 20 years or something, I'm writing the asset off evenly for tax purposes. So I draw the line. Okay, and then for carrying amount, when we do cost model, that's the line. It would be over many more years. Okay, so coming down here somewhere. Okay, and if I use revaluation model, when there's an upward price shock, I'm going to jump up from 800 to 1.2. Do you all understand the graph? Okay, so whenever I'm doing deferred tax, all I'm doing is I'm looking at that graph and I'm saying, which carrying amount do I have? Well, it depends which model I'm using. If I'm using cost model, my carrying amount is 800, okay, and my tax base is 500, so my difference is 300. Okay, I'm below original cost, so even if I have differential tax rates, I'm just going to be using whatever my normal tax rate is, assuming there's a recoupment of past allowances at the normal tax rate. So it's just 300 times by the tax rate. If I'm using revaluation model, okay, because you only have one tax rate, it's still easy for you. You just take 1.2 compared to 500, the difference times by the tax rate, and you finished. But in some other jurisdictions where they've got differential tax rates, it's not so easy. Okay, because now if I'm going to recover through rental income, so I rebut the presumption, okay, then all of it is going to be at the rental income tax rate, which in our example would be 30%. But if I don't rebut the presumption and I assume I'm going to recover through sale, therefore, in most tax jurisdictions, from 500 back up to one. So if I sold for 1,200, this is how you think about it. If I sold today for 1.2 million, how much tax would I pay? And if the tax law said from 500 back up to the original cost that you paid, that 500 is going to get taxed at 30%. But the bit above 1 million up to 1.2 million is going to be taxed at, in South Africa, it would be half the rate, so 15%. Okay, then I would have just create deferred tax at 15% on that bigger, on that 200, but at 30% on the 500. You will see how that works. Okay, but that's if the tax consequence that followed from sale on that day, if I sold for 1.2, in some jurisdictions, I would be taxed on 500 up to original cost. Okay, so from 500 up to a million, that part of the gain would be taxed at 30%, but the gain above a million up to 1.2 million would be taxed at 15%. So I just multiply it out, 15% of 200 and 30% of 500 added together, and that's my deferred tax. Okay, but you're lucky, you don't have to worry about that. You just go 500 minus 1.2 million times by the tax rate and you're done. Okay, so it's easy, isn't it, for you? Okay, it's more difficult for some other people. Okay, so for that reason, we don't have to go through all these scenarios because you would get the amount anyway. Okay, maybe it is worth looking at deferred tax in a business combination for you though. Okay, because in a business combination, you have these exceptions that apply. So you need to be able to work through those exceptions. Okay, so you can see the regulators saying, oh, I see business combination, and then the deferred tax I'm seeing on the business combination doesn't look consistent with, okay, something's wrong here. I'm going to ask some questions. Okay, so there was in a business combination, a master franchise agreement. It looked like deferred tax wasn't raised on the master franchise agreement. There's no exception for those types of assets, so there should have been deferred tax. So goodwill has been overstated. Okay, because if you understate deferred tax liability, you're overstating goodwill. Okay, so there's an error in the prior period financials. Okay, fix it next year in your comparative numbers. Okay, so that's essentially what happened there. Okay, so let's do a fairly straightforward example, which I think you will have in North Macedonia. So you have a business combination, you're acquiring another business, and that other business is in a separate company. So in company Z that you're acquiring, the carrying amount, and they're using a cost model, and the depreciation rate they're using is the same depreciation rate that there is for tax purposes. So in your subsidiaries books, on the day you acquire your subsidiary, there's no deferred tax. Okay, the carrying amount of the asset is, what did we say, 500. Okay, and the tax base of the asset is 500. But on the day you acquire your subsidiary, in the group's accounts, the business combination accounting says you must put that machine at fair value. The fair value of that machine is 750. Okay, so in your group books, the carrying amount is 750. In your subsidiaries books, it's at 500. the tax base is 500. So now from a group perspective, you have deferred tax, where at the subsidiary level, there is no deferred tax. Does that make sense to you? Okay, so put another way, on the day that you acquire your subsidiary, the group carrying amount is fair value of the machine, which is 750, but in the company's books, it's only at 500. The tax base is 500, so at the company level, there's no deferred tax. But at the group level, there is deferred tax. At the group level, carrying amount 750, tax base 500, temporary difference 250, times by 30%, there's 75,000. If you don't create the deferred tax liability, you will overstate goodwill. So there would be two errors. Your deferred tax liability would be wrong and your goodwill number would be wrong. Okay, because goodwill's the residual in the business combination accounting. So if you don't count a liability, you're going to overstate the asset. Everybody happy? Okay, so that's basically what it comes down to. Okay, so does everybody understand the at acquisition position? Notice there's no effect on the income statement because the adjustment is to goodwill, not to profit or loss. Okay, but next year, things are different. So next year, and maybe we'll just jump forward to this slide here. Next year, if we are our subsidiary is depreciating the asset evenly over the remaining 5 years, the tax authority is depreciating it evenly over the next 5 years. We depreciating it evenly over the next 5 years. Okay, but we depreciating 750 when the tax authority is depreciating 500. So when we get to the end of the first year, we would have had 150 depreciation, we'd be down at 600. The tax authorities would be down at 400, so we'd get 100 tax deduction, but in accounting, we've got 150 expense depreciation. Okay, so now our temporary difference is 200, okay, which means our deferred tax liability at 30% is 60,000. So our deferred tax liability is changing from 75,000 to 60,000. So it was nil at the beginning of the year. Okay, so it was nil before the business combination. No effect of the initial recognition of the deferred tax because that affected goodwill, but the change from 75 to 60 does affect the income statement. Okay, so you've got depreciation expense of 150, okay, but you're only getting a tax deduction of 100. Okay, so that difference is going to come out as a reduction in your deferred tax from 75 to 60. So you are going to have 15,000 income. Do you agree? You agree? Everybody happy? Okay, so your group accounts are showing deferred tax where your subsidiaries accounts are not showing deferred tax. Okay, so group accounting is different when it comes to deferred tax because your carrying amount is different, but your tax base is the same. The tax base is the future deduction that the subsidiary is going to get. Okay, and then you just work through and you can see how each year you're going to have 150 accounting depreciation, but you are only going to have 100 tax depreciation. Okay, so you can see that there's going to be 15 income from income tax on this every year. Everyone happy? Okay, so what if it was a goodwill asset? So remember, with a goodwill asset, there's two scenarios we need to look at. The one is like Poland, where you get a tax deduction for goodwill, and the other is like everywhere else I'm aware of in the world. North Macedonia, do you get a tax deduction for goodwill? No? Okay, so you're not Poland. Poland's the only place I've seen this. Okay, so in Poland, they would account for the deferred tax. So scenario A was goodwill is amortized for tax purposes. Okay, so scenario B is the scenario that we would be in here. Okay, so in Poland, they would be accounting for deferred tax. Okay, so they wouldn't have an exemption. Okay, but here you would be accounting for, you would not be accounting for deferred tax. So let me just take you through that. Your carrying amount of goodwill was 100. Okay, your tax base of goodwill is nil. So you've got a temporary difference of 100,000. So if that was plant, we would be creating a deferred tax liability on it. Okay, but because it's goodwill and you're not going to get a deduction for goodwill for tax purposes, we exempt it from deferred tax. So deferred tax is nil. Okay, and it's not going to change. It's going to remain nil. Everybody happy because of the exemption? Okay, there we go. Okay, the next thing we can have a look at is tax losses. So tax losses obviously very relevant in every jurisdiction. You make a loss, okay, how does that affect your deferred taxes? Okay, so, you know, the measurement restrictions around recognizing tax assets, okay, is that you need convincing evidence. So the way the biggest accounting firms that I look at are interpreting that, you need a threshold that is at least more likely than not. They're happy with higher, but not lower than more likely than not. So that's kind of the level of recognition criteria that we are looking at. Okay, so regulators who review financial statements see problems with the way that tax losses are accounted for. Some people under account for tax losses. Some people over account for tax losses. Okay, with a vague recognition criteria, people know they can manipulate profit by how they account for tax losses. Okay, so regulators watch this, okay, because, you know, it's clear sometimes people should be accounting for tax assets they're not accounting for, and others are accounting for tax assets that they shouldn't be accounting for. And obviously, where you have this vagueness in the recognition criteria, it's important that people make disclosures so people can understand well how they've applied that recognition criteria. So we expect entity-specific disclosures, and we don't always see this. We need disclosures about what that convincing evidence is, if you have convincing evidence to recognize it, for example. Okay, so the regulators see quite a few problems in the area of recognizing deferred tax assets. Okay, so typically they'll ask for information. When they ask for more information, it often leads to people admitting that they haven't done it properly and restating their comparatives in their next set of financial statements. Okay, so we're going to look at 4 scenarios just so that we can understand the recognition criteria properly. So one example in that there's 100 million loss. Okay, so the 100 million loss for tax purposes and accounting purposes. So tax is equal accounting. So we have this loss. The question is, should we be raising a deferred tax asset in respect of this tax loss, or should we not? The tax rate is 30%. We can carry forward 3 years, which is, I understand, your requirement, 3 years. Okay, so after which, if you haven't used it, it falls away. Okay, so the first scenario, did we say that? Tax losses are carried forward for 3 years, yeah. Okay, so the first scenario is in 2024, the manufacturer has this big loss. Okay, and the reason why they have a loss is because a rock shot out of space, okay, and whacked one of their factories. They have other factories, all their factories are profitable. The only reason why they have a loss is because there was this freak event that resulted in this loss. So next year, the year after that, they expected to be profitable. They expect to recover their tax loss. So how much is their tax loss asset that they should raise? Deferred tax asset for tax loss. So it's 100 million times 30%. You would expect a tax asset of 30 million, wouldn't you? Everyone happy? Okay. The only reason why we had a loss was because there was a freak accident. We expect to be profitable going forward. We have every confidence that we will recover this tax loss. Okay, so in the second scenario is different. The reason why we made this loss, is because our country took away trade barriers. So we had tariffs, so we didn't have to be efficient. So the government has taken away the tariffs for imports, so now we can't compete with the imports. Okay, so in this case, do you think we are likely to meet the criteria of having convincing evidence that we're going to recover our tax loss? No. Okay, so here we're not raising a tax asset. Okay, because we're inefficient, and in 3 years, we're not going to become efficient. Okay, so we're not going to recover our tax loss. It's just going to be lost. Okay, in the next example, the government is consulting on whether to reintroduce tariffs, and there's a 50-50 probability that they will reintroduce tariffs. Okay, so if it's 50-50, can we recognize the deferred tax asset? No. Okay, and if it's just over 50, can we recognize the deferred tax asset? Yes, if we set up. Okay, so you can see the problem, can't you? Okay, but if it's 50-50, no, we can't recognize the deferred tax asset. Okay, so the next one's a bit of a weird one. So we must be building something like a big ship that takes a long time to build. So we have enough orders to break even. If we get one new order, we'll make 40 million profit in the next 3 years. If we get 2 new orders, we think we'll make 100 million profit. How much deferred tax asset can we recognize? So this one we're going to do a poll on. Okay, so if we can do a poll on this one, how much deferred tax asset? Okay, you can discuss with the person next to you if you like. Yeah, I can go back here so you can see the facts. How much deferred tax asset? Anyone with a number? Okay, so in the Zoom room, we've got some people coming in. Okay, so some people are coming in at, well, I actually can't see the alternative. So some people are coming in at, what is it, 12 million. Some people are coming in at, yeah, I'm not sure what that number is in number 3. Okay, and some 0. Okay, so some people are coming in 0. Some people are coming in at 12 million. What do we have in the room? And somebody at least is coming in, it depends, at the bottom. Yeah, do you want to discuss with the person next to you quickly? I see we're down to 14 in the Zoom room. Okay, so it is getting smaller. But only 14 voting. Okay, interesting. Okay, so maybe let's take a vote. Who says 30? Okay, who says 12? Okay, who says no? Okay, who says 14.4? Okay, the economics. Okay, so who says another number? It depends. Okay, it depends is the right answer. Okay, so what does it depend on? What does it depend on? How do we specify? You need convincing evidence. What's the threshold for convincing evidence? At least more likely than not. So you might specify higher. You might specify 75%. And if you've specified 75%, no. If you specified just more than 50, I can't remember, okay, then it's 12. Okay, so it depends, doesn't it? Okay, it depends on where you've specified that recognition threshold. Okay, does that make sense? Yeah, yes, please, please. Thank you. Okay, so the next thing that we're having a look at is one more, two more. Yeah, there we go. Okay, so the next thing we're having a look at is tax loss carried forward during a tax holiday. Okay, it's no different. It's the same. Okay, so in a tax holiday, governments will say you don't have to pay tax in the tax holiday. So no tax this year, no tax next year. So in our example, we make a profit in the first year, so we don't pay tax. We make a loss in the second year. So now how far can I carry forward my tax loss that I made in a tax holiday? Okay, and it'll depend on the rules in the jurisdiction or that particular tax holiday even. Okay, because sometimes to attract a big company to invest in your country, you'll offer them a tax holiday. Okay, so the tax holiday might even be specific to that particular investment. Okay, so in this example, in 23, they made a tax profit. We didn't tax them because it was a tax holiday. 24, they make a tax loss. So we say, look, you can carry that forward from 24 to 25, but you haven't used it by the end of 25, it falls away. Okay, so you can only carry forward 1 year. So you realistically try and forecast what your future taxable profits are. We forecast 40 for 25 and 50 for 26. So how much tax loss can we create as an asset? Okay, if we've passed the recognition threshold on the 40, 4 threes are 12, isn't it? Okay, that's it. Okay, the rest is going to fall away. Okay, so it's going to be 12. Does that make sense to everybody? Okay, so sometimes you have, and you'll have to tell me whether you have this in North Macedonia or not, but you have different rules for capital profits and losses than you have, and not just tax rates are different, but carry forwards can be different. Okay, so in North Macedonia, the same, you don't differentiate at all. Okay, not a problem, we can skip over it then. Okay, so, oh, you have such an easy life. Okay, everything that is difficult, you don't have to do. Okay. Okay, but in some jurisdictions it is different, and in the jurisdictions where it's different, you have to, worry about all of this. Okay, but you don't have to worry about it, so we can skip over that. Okay, something I know you're not doing properly, okay, is tax rate reconciliations. Okay, so this is very badly done almost everywhere in the world. Okay, why? I don't understand. Okay, it's not difficult. Okay, so tax rate reconciliations is a particular disclosure that you have to make, basically explaining why your effective tax rate is different from your standard tax rate. So whatever your tax rate is, you expect a company to explain why. Say your standard tax rate is 30%, but when you look at the company's income statement, you see tax expense, you divide tax expense by profit before tax, and you're not getting 30%, you're getting some other number. So the companies are supposed to explain why that number is not 30%. It's not saying it's wrong, it's just saying when you did your taxes, you've come to a number other than 30%. I reasonably expect it's 30% if that's the tax rate. So please explain to me why it's not 30%. Okay, and explain it properly so that I can determine for myself from your disclosures what I think next year's tax rate will be effective tax rate. In other words, don't just tell me permanent differences. That means nothing. Okay, so what are those permanent differences? So I can decide whether I think they're going to persist or not. Okay, so this is very, very badly done. Okay, so there's a lot of improvement that can happen here. Okay, so, you can see the regulator, this is the UK FRC, saying it's unclear what these significant items in the reconciliation are. That's bad. It's no good just writing something nobody understands, difference, okay, no good, okay. And then when that information is inconsistent with information elsewhere, then questions get asked. Okay, why is that the case? So you can see here, there's an example of a particular company that they're naming that included a reversal of a temporary difference. And you think, well, why would a reversal of a temporary difference be in your tax rate recon? Okay, because remember when we did deferred tax, remember accounting profit was 300, tax was 90. Okay, that's what we expected. That's current and deferred together coming to your effective tax rate. So if a temporary difference is reversing, that shouldn't be affecting your tax rate. Okay, so it should still be 30%. Okay, so if we see that, we can ask questions. Why? Is there some reason why that's the case? Okay. Yeah, oh no, mistake, restate your financials. Okay. And then, you know, this is now the South African regulator who regulates this very well, I think. They say, hold on, it's just not clear enough. I need to understand the impact of all these differences. So I want to be able to understand the relationship between accounting profit and tax expense. Okay, and if there's unusual, I want to understand why it's unusual. And if it's going to be different in the future, I want to understand why. And it's no good just telling me non-deductible expenses. You're just wasting my time if you do that. Okay, so this regulator is taking a careful look at tax rate reconciliations and saying, you've got to do better. Okay, so now back to the UK, you can see they're asking questions about tax rate reconciliations, they're very nice, could we have more meaningful, you know, aggregate reconciliations? Okay, so just do it better. Okay, very nice way of asking. Okay, so where you have companies that are operating across multiple jurisdictions and each jurisdiction has a different tax rate, then it becomes difficult to prepare your tax rate recon. Okay, because what's your standard rate? Is your, you know, if it's 30% in this country, 10%, 20%, what should my standard rate be? Okay, and what they're saying is, well, maybe you could use a weighted average. So come with a weighted average. Okay, I've seen it done where you will use your main country's tax rate. So if you're a big North Macedonian company and you've got a little subsidiary somewhere else, okay, then maybe you'll just use the North Macedonian rate and show a difference for the tax rate difference between the other jurisdiction and this jurisdiction, you know, if it's just a small difference. But if both are big operations, then maybe you could use the weighted average of this jurisdiction and that jurisdiction to do it. Okay, so there are different ways it can be done. There's not only one right way of doing this. Okay, but these are some of the suggestions that we're coming up with. Okay, so these differences come largely from what we call permanent differences. So not timing differences, but differences that are permanent, and where we have tax loss carry forwards that we haven't raised deferred tax assets for. Okay, so we're going to do some examples to show you what we think it should look like. Okay, so it's a fairly straightforward example. We've got a 30% tax rate. Taxable profit is the same as IFRS profit, except donations expense, entertainment expense, you don't get a tax deduction for. So you can have accounting expense, but you're not getting a tax deduction for that in this jurisdiction. And tax losses can be carried forward 3 years, and the normal rules for recognizing tax losses apply. So in the first year, 2023, our accounting profit is 900. To arrive at the accounting profit of 900, we've deducted a donation expense of 100,000. So how much would our tax expense be? There's only current tax, there's no deferred tax. Okay, so it would be 1 million that we would be taxed on, 1 million at 30%. Okay, 300,000. Everybody agree? Okay, so we're starting with something easy. Okay, so if that's the case, what would our tax rate reconciliation look like? Accounting profit, reconciling accounting profit to current tax. We started with 900, we added back the non-deductible expense, gave us a tax profit of 1 million, and then current tax was 300. That's what we've just done. So our tax rate reconciliation could be presented in 2 ways, would be fine. Either of these ways would be fine. We could either say accounting profit was 900. So on 900 at 30%, we expected tax would be 270. Why wasn't it 270? Well, there was this non-deductible donation expense, not just non-deductible expense, non-deductible donation expense was 30. Okay, so therefore we were taxed on 300. So 300 tax expense divided by accounting profit of 900, the effective tax rate is 33%. So that's one way of setting it out. The other way is to say, you can see 30% is the expected tax. So, you start at 30, then there's an added 3.33 for this non-deductible donation expense. So our effective tax rate is 33.33%. Either of those ways is fine. They are doing exactly the same thing. Does that make sense to everybody? Okay, but notice the detail: non-deductible donation expense, not just permanent difference, non-deductible expenses. It's more specific than that, and that is necessary. Okay, so now we get to the next year. And in the next year, we make an accounting loss of 400,000. And in arriving at the accounting loss of 400,000, we have a non-deductible entertainment expense of 100,000. Okay, so how much is our current tax? Okay, how much? Okay, we're going to do this one by poll. Okay, so how much is our current tax? So our accounting loss is 400,000. Okay, entertainment expense is 100,000. You don't get a tax deduction for entertainment expense. Okay, how much is our current tax? You can carry forward tax losses. Okay, so let's just, we'll just wait for the votes to come in from the Zoom room. Okay, so is it 500,000, 400,000, 300,000, 130,000, 100,000, 90,000, or nil? Okay, so let's see what we get. Okay, so we're getting a range of answers. Okay, so we're asking only about current tax. Okay, so current tax is what's going to happen? Nothing. Zero. Okay, because you're making a loss. Okay, so nil. You're not going to pay tax when you're making a loss. Okay, so if we look at deferred tax, how much is deferred tax? Okay, so we can't take a vote on the deferred tax, but how much is the deferred tax? So if we close the poll now. Goran, if we can close the poll. Thanks. Okay. So now we're thinking about deferred tax. Okay, so this is our calculation for current tax. So we've got a loss. Okay, you can't, the government's not giving you money back for making a loss. They're not that nice. Okay. Okay, so now when we look at deferred tax, there's two possible answers we could get. Okay, because it depends on what we have convincing evidence for, doesn't it? Okay, so if we have no convincing evidence, it's going to be nil. And if we've got convincing evidence we can recover all of it, it's going to be 90,000. Okay, so there are two possible answers, aren't there? In fact, it could be something in between. Okay, but we're just going to look at two possible answers. Okay. Okay, so if we've got two possible answers, now let's look at our tax rate reconciliation. So in scenario one, we're raising the deferred tax asset. So we're raising deferred tax income of 90,000, aren't we? Okay, so now if we go there, accounting loss was 400,000. We expect we would have tax income of 120,000. The reason why we don't have 120,000, even though we've raised deferred tax of 90,000, is because we have this non-deductible entertainment expense of 30,000. So now if you look under scenario 1, our tax rate reconciliation, we had 400 accounting loss. We therefore expected that we would have at 30% 120 tax income. We don't have 120 tax income. Why? Because we've got non-deductible entertainment expense of 30. Okay, we did raise the income tax, deferred tax, so that's why we have 90 income. Okay, so our effective tax rate is 22.5%. Okay, and then you go look, so that's 90 divided by 400. Okay, now you go to the other year, the other scenario, okay, where we didn't raise the deferred tax expense, so the deferred tax income, so we've got nil tax, no current tax, no deferred tax. So tax is nil. Okay, so to get to nil, if you're looking at the percentages, on 400, we expected 120, which would be at 30%. But then there's this non-deductible entertainment expense. And then we didn't raise the deferred tax income on the deferred tax. Well, we didn't recognize the deferred tax asset. Okay, so with that information, you understand quite well why you have the effective tax rate that you have. That's the sort of information we expect. Okay, does that make sense to everybody? Yeah, it's not difficult to do. You just have to show the detail of why your effective tax rate is different from your standard tax rate. Okay, now some jurisdictions, and I don't know, sometimes you can have particular companies within your jurisdiction that have the right to carry back tax losses. Anybody aware of carry back? In other words, I made a profit last year, tax-wise. I make a loss this year. So the government says, okay, I'll give you back some of the tax you paid last year. Okay, so some jurisdictions have that. In some jurisdictions, it's only for particular companies. Okay, many jurisdictions just say, no, we don't give money back. Once you've paid us, thank you. Make a loss. Okay, you can offset it in the future if you're lucky enough to make a profit in the future. So there's nobody that's aware in North Macedonia of anybody who can carry back tax losses. Okay, you don't have to worry about this next bit then. But if you could carry back tax losses, then it would become current tax income, wouldn't it? Because you're expecting a payment. Okay, so it would be current tax, not deferred tax. Okay, but you don't have to worry about that. Okay. So the next important thing is uncertain tax positions. Okay, so this is that funny IFRIC interpretation that was issued. Okay. Well, tragic or funny, depending which way you look at it. Okay, so you can see regulatory issues where there's uncertain tax positions. People want disclosures so they can understand those uncertain tax treatments. Okay, so tax law is seldom clear on everything. There's typically something in tax law that is not clear. Okay, so when you're filling your tax return in and it's unclear what you have to do something, don't you? Okay, so this is dealing with those uncertain tax positions. And most jurisdictions have uncertain tax positions. Tax law is written by politicians typically, okay, and politicians aren't very good at writing, it seems. Okay, so tax acts are seldom very clear. There is usually some things that aren't clear in a tax act. And then you fall into one of those unclear categories and you're not sure what to do in your accounting. Okay, but in doing your accounting, you should assume that the tax authorities have full knowledge. So there's no information being hidden from the tax authorities. Okay, but now we have to think differently about how we do this accounting. So this IFRIC 23 is a bit strange because it says you think about how you filled your tax return in. And if you filled your tax return in saying it's taxable, this item, and then you write a note to say, I'm not sure whether this is taxable, but I'm going to pay tax on it now. And if it's not taxable, please give me some money back. Okay. And it's probable that the outcome is that it is taxable. In other words, what you have done in your tax return, then you just assume it's fully taxable in your tax return. And if you think it's not taxable, you've put it in the not taxable part, and you've said, but look, there's a little bit of uncertainty. I'm happy to pay the tax if I have to, but my reading of the Tax Act, I don't have to pay tax on this. And the probability you assign to it is that you are right. Okay, then you pretend that there's no possibility it's going to work out the other way. So this is very strange that accounting would be written this way, but that's how it's written. The trouble is when you fill your tax return in a way that is different from what you assess to be probable, then you do have to adjust in your numbers, in your accounting to what is probable. Okay, and the way you measure what is probable is different if it is just an on-off switch. So it's either going to be taxed or it's not going to be taxed. Okay, so that's full amount or nil. Then you have to just put in your accounting the most likely amount. But if it's a whole lot of small amounts, some might go this way, some might go this way, some might be taxed, some might not be taxed, then you use expected value. Or if it's one amount and the discussion is how much of that amount should be taxable, so it might be 10%, it might be 20%, it might be 30%, okay, then you still use expected value approach. So you use the approach that best reflects what the likely outcome is going to be. Okay, so it's strange, but that's how it's written, so that's what you have to do. Okay, so the easiest thing to do is to do some numbers and see if we get the right numbers from what we've discussed so far. Corporate tax rate is 30%. You've got a taxable income before uncertain items, so there's no uncertainty about $1 million, you're going to pay at 30%. But then there's this one other item, another income you've got of 100,000, and it's not clear whether this is taxable or it's not taxable. But it's either all taxable or all not taxable. It's an on-off switch. Okay. You have included that gain as taxable in your tax return with a note to say, if I'm wrong, please refund me the money. Okay. Okay, likely, good luck. Okay. Okay, and you assign a 60% probability to what you've done is right, a 40% probability that you'll get the money back. Okay, so what number are you putting in your accounting for current tax expense? Are you putting $1 million times 30%, which is 300,000? Or are you putting something more for this uncertain tax position? Okay, and if you say something more, how much more are you putting for the uncertain tax position? Are you putting the full, should it be the 30,000 or should it be 60% of 30,000? 18,000. 30,000 or 16% or 60% of 30,000, because there's a 60% probability. So the economics would be 60% of 30,000, but accounting, we don't do the economics. Okay, so we just put the full 30,000. Why? Because it's probable. Okay, so in that case, it's going to be 330,000. Everybody agree? Okay, so now let's change another scenario. So it's the same facts, except now we have excluded the gain from taxable profit. So in our tax return, we think there's a 60% chance it'll be taxed, but when we fill the tax return and we put it in the non-taxable field and we write a little note and we say, oh, we're not too sure, but we think this is not taxable. This is more likely what's going to happen, isn't it? Okay, so now, but there's still a 60% probability that it's going to be taxed. That's what you've assessed. How you come up with these probabilities, don't ask me. Okay, the standard says if you've got you have to come up with the probabilities. Good luck, come up with the probabilities. Okay, if we're not telling the truth, we have to write the rule. These are the rules, come up with the probabilities. Okay, so now if there's a 60% probability that what you've done in your tax return is wrong, then what do you have to do? You have to put it in your accounting and you measure it. If it's an on-off switch like this one, still at 330, don't you? So you're still at 330. Everybody agree? Okay, so even though now you're different from your tax return. In your tax return, you've put it in non-taxable with a little note saying, please, I hope I'm right. Okay, but okay. Okay, so now we change the scenario. We've now changed the probability to 40%. and we've excluded it from our taxable fields in our tax return. So we've told them about it. So it's in our tax return, but it's not as taxable. It's at non-taxable with a little note saying, I hope I'm right. Okay, so what number are you putting in your accounting now? It's an on-off switch. It's either right or it's not. It's binary. It's either in or out. It's no halfway measure. So now what number? Okay, so number one is 300,000. Okay, because that's what the IFRS says. Okay, so that's what you have to do. Strange, isn't it? Okay, but that's what you have to do. Even though the economics is, what would it be? It would be 40% of 30, which is 12, isn't it? Okay, so you're never doing the economics, it seems. Okay. There are some people that find it strange in accounting if we use expected value when it's an on-off switch, because they say, well, it couldn't possibly end up being expected value. It either has to be in or out. Why is that strange? Surely businesses are full of things that are either on or off, and you're never looking at isolation when you're valuing a company at one thing. You're looking at everything in that company. So of course, everything comes back to expected value, doesn't it? So why do we think it's illogical to put a number that for that specific thing, it can't happen? It'll either be 330 or it'll be 3. Why? But some people, okay, and they seem to win the argument too often. Okay, so our last scenario, we're back to 60% probability, but it's not binary now. So now the number could be anywhere between 300 and 330. You with me? Okay, because it's either lots of little items or if it's one item, okay, it's not necessarily all taxable. Some amount of it will be taxable. Okay, so now we have to use expected value, don't we? But if we filled in our tax return that it's taxable, which we haven't done, if we had filled in our tax return that it's taxable, we would use 330, even though that's not economically what the answer is. But we've excluded it from tax. So then we're doing different in our tax return from what the probable is. So when we come to do the accounting, we have to put it in the measurement. And because this isn't an on-off switch, we must use expected value. Okay, so expected value would be, what is it? 30 times 6, 6 3s are 18, 318. Does that make sense to everybody? Okay, so if we're not going to tell the truth, we have to write the rules for not telling the truth. Okay, so then the rules are complicated and you have to remember all the rules. Why the interpretations committee thought we didn't just want to tell the truth, I don't understand. Okay, but this is what they came up with. Okay, and the board signed off on it, so this is IFRS now. Okay, Pillar 2 income taxes. Remember we discussed this earlier today. Okay, so coming back to Pillar 2 income taxes, there's an exemption for deferred tax, so you don't have to recognize deferred tax on Pillar 2 taxes. Okay, I think we've said that already today, actually. Okay, so there's nothing much to know about Pillar 2 taxes, maybe some disclosures, that's it. Okay, so if it's current tax, Pillar 2, you have to show the number for current tax. You have to calculate it and put it in your balance sheet and income statement. But if it's not current, it's deferred, you ignore it and you just write some disclosures about it. Okay, so just as a source of information, okay, these are the places that I looked. I looked at the JSE. They actually do a combined findings. So they not only tell you every year how they have regulated companies, they keep an updated publication by standard of all the regulation they've done in the past that is still relevant today. So they take stuff out that's no longer relevant. Okay, so it's a very useful piece of information that I use it all the time. Okay, so this is where they've regulated over many years, everything that's still relevant by standard. Okay, in one document, you can find this. The UK FRC does differently. They publish every year, but they don't combine it and tell you what is still relevant. You have to look at it and decide what's still relevant. Obviously, if it's new, it's more likely to be relevant than older stuff. And IFRIC agenda decisions. And then I didn't look for this particular presentation, but I've also been looking at the ESMA, the European Collection of Regulators. Occasionally, they publish something useful. Okay, and then that provides a good source of information. Theirs tend to be at a much higher level and not that helpful to use as examples because they don't give you enough information about the piece of regulation that they have done. Okay, so I'm sure it's good regulation they're doing, but they don't publish it in a way that makes it easy for us to use to do better in the future. Okay, so that's pretty much everything that I wanted to do with you. I did make some more detailed mini case studies, but they're all about where you've got different tax rates for capital and not capital, and you don't have that. So the good news is you get to go home early, okay, because there's no point in taking you at the end of the day through a whole lot of stuff that is not relevant to you. Okay, but before we close, just any questions anybody has. Obviously, we're happy to answer any questions that you might have. Any questions? Okay, so when I've looked at North Macedonian financial statements and looked at the tax section, okay, I don't see very good disclosure. Okay, so I'm thinking some of what we did today is probably a little bit of a surprise to you. Okay, so I think this is an easy area for you to make quick improvements, basically. Okay, doing tax rate reconciliations is not that difficult. You just have to explain why you're not coming out at the standard rate, you're coming out at a different rate, and do it in a granular enough way that people can understand what all those differences are. Okay, that's not difficult to do. That's just, you know, people aren't doing it properly. That's all it is. Okay, so I think there's easy ways where you can get fairly quick improvement in your financial reporting from some of the things that we've done today. And then leasing's new. We had lots of questions on leasing because you're all thinking about, I have to do leasing and how's this going to be different? Okay, but you can make improvements not just when something's new. You can make improvements to what's old and not been done well. Okay, so make improvements there too. Okay, and you know, gets better each year. I've looked at all types of entities. Okay, so it's not to say everybody in North Macedonia has done a bad job, okay, because I have seen examples where I've said that's okay. Okay, so I'm not saying everybody's doing a bad, I'm just saying when I look at quite a few sets of financial statements, I think, okay, the problems the other regulators have found, they are here too. That is what I'm saying. Okay, so, and I can't remember specifically which type of entity they were in. Okay, but if I looked at 10 sets, I found 7 that I thought, oh, in income taxes, I can very easily see you can easily make some improvements here. Okay, but maybe there are 3, I thought that's okay. Okay, and that's probably true of most jurisdictions, to tell the truth. So most jurisdictions do this badly on average. Okay, so I'm not being particularly hard on you. I'm just saying, okay, improve. Yeah, that's our hope anyway. That's what the regulators are trying to do when they're publishing this information in their own jurisdiction. They're saying, this hasn't been done very well in our jurisdiction. Here's examples of good practice, or better practice, they call it. And here's the things I'm seeing wrong. I'm not looking at every set of financial statements, but if I'm finding it in 7 of 10, then it's probably in 7 of 10 across the whole population. So the others that I haven't had a look at this, and then that will help you improve, basically. I mean, that's the thinking. And that is generally how regulation of IFRS financial statements is done in the world. It's just, we understand the first time you do something, you're probably not going to do it properly. Okay, you're going to try, and it's not going to be perfect. Okay, so then we try and support you to do better. I'm speaking about your regulators, try to support you to do better. Okay, because some of it's not easy. I mean, look at some of the stuff we've discussed today. Okay, all those different rules, having to remember them, that's difficult. Okay, and then making the judgments, if you're not used to making those judgments, can be difficult. But with practice, it becomes easy. You look at when fair value measurement first came out, IFRS 13, number 1 problem in every IFRS jurisdiction. Now, number 10 problem, number 12 problem. Okay, why? We have practice now. We have had to do this a few times. And we had one UK company calculate fair value, mid-tier audit firm comes to audit fair value calculation. Regulator goes, no, not fair value, go away, restate your financial statements, come back next year, different way of measuring fair value. Regulator has a look, still not fair value, go restate your financial statements. Okay, now that problem's gone. It's no longer a problem in the UK. It's no longer a problem in South Africa. They can measure fair value now. Okay, but if you're not regulated on it, and the Johannesburg Stock Exchange had, you know, level 1, level 2, level 3 fair value. So they regulate a lot the equity listed companies. They're looking at their financial statements. They're telling them level 1, level 2, level 3, checking everything. Some companies are saying, I've got property investment property, and it's level 2 because somewhere in IFRS 13, they read you can have level 2. Okay, and the regulator says, not in South Africa, you don't have level 2 for investment property because they're just not enough. It's not like London or Singapore or New York where there's lots of trades. And if you know the square meterage and the area, you can do the valuation. That's all you need. That's level 2. Okay, South Africa, not like that. Okay, there's just not enough transactions. There's not enough homogeneity. Okay, so it's just not that way. And then with the listed equities and listed debt instruments, they come to look at the people that have trading their debt on the Johannesburg Stock Exchange. And people say it's level 1 because it's on a stock exchange. And the regulator says, are you mad? How can that be level 1? It's not level 1 because it trades on a stock exchange. It's level 1 if there's an active market for the trading in that particular thing. There's no corporate debt that trades actively enough to be level 1 on the Johannesburg Stock Exchange. So all these companies have level 1. No, it's not level 1. Okay, it's at least level 2, if not level 3. Okay, and why do preparers want to say it's level 1 when it's really level 2? Less disclosure if it's level 1. And then the investors say level 1, this is high quality. I can put a high multiplier. No. Okay, so it's important to have the right level. Okay, so you can see, because it's trading on North Macedonia Stock Exchange does not mean it's level 1. Okay, is it trading every day in sufficient volume, okay, for you to be able to get ongoing pricing? And if the answer is no, it's not level 1. Okay, so the fact it's listed is not level 1. Okay, and then level 2, what does level 2 mean? Okay, no significant unobservable inputs. Okay, so what does that mean? Okay, so a company should be telling you if it's got lots of things that are on the line between level 1 and, between level 2 and level 3, it should be telling you how it works out, which is on what side of that line. Because the standard is a bit vague, no significant unobservable inputs. So if you look at HSBC Bank, they explain how they draw the line between level 2 and level 3. Basically, if it's more than about 5% of the value of the instrument is driven by unobservable inputs, then it's level 3. Okay, but where did 5% come from? That's HSBC's decision of what that is. Okay, so you can see it's a bit of a vague notion. Don't get me started on fair value. We will still be here tomorrow morning. Okay. Any other questions? Okay, anybody in the Zoom room with question? Okay. Okay, so I'm just trying to understand this. Hey, this question relates to the previous presentation about IFRS 16. If the company leases office premises and has an investment in the leased property, okay, how would they now present the lease under changes under IFRS 16? Should the investment be? Okay, I'm going to have to think about that question a bit because I'm not sure I understand it even reading it. Okay, so there's something about leasing. The company leases the office and has an investment in the leased property. So you both the lessee and the lessor on the same property. So I'm a bit confused about the question. I just need to understand it better. Okay, and I'll think about it and hopefully be able to give you an answer tomorrow. Okay, I won't keep you any longer. Thank you for your attention, and we will see you tomorrow for the final day of the workshop. So thank you very much for your attention.